$3,000 an ounce? No. $30 an ounce or $35 an ounce for silver? No. And frankly, we're on the verge of a crash right now. Everything is doom and gloom, but there's always opportunity in crisis. They can create more of this, and the more of this that they create, the less and less and less value they have. That there is a banking crisis that is unfolding right this second that you're not seeing yet. They're going to go and you're going to see bank runs all over the place.
All right, Lynette, it's wonderful to see you again. First of all, thank you so much for sitting down with me. It's been a while. How have you been?
Oh, I've been great, and I'm so glad to be back with you, Antonio. Thank you for having me.
Pleasure is all mine, of course. And for people watching, I'm just going to assume everyone knows who you are. And this is Lynette Zang of Zang Enterprises. So go to LynetteZang.com if you want to know more. I'll link it in the show notes as well, where you can see it. Or go to the YouTube channel, Lynette Zang's YouTube channel. She's got her own YouTube channel doing a bunch of eye-catching, eye-popping things. One of the recent videos is actually something that I wanted to talk about, Lynette, because you call it, how do you profit from the next market crash? And I was like, hey, I want to profit. I like profit. What do I do?
Right. Well, because everybody thinks everything is doom and gloom, but there's always opportunity in crisis, as long as you're in the right place at the right time with the right asset. We're watching all of these fiat money assets kind of explode, right? Upward. Although we can talk more about that in a minute. And what that's doing is creating nominal confusion. Look over here, don't look over here. And that's to keep their wealth inside of this very, very fragile fiat money system, government debt-based money system. It makes it so much easier to rob your wealth. But the way that it works, I mean, it really is simple. Trees do not grow to the sky, right? And this is being artificially pumped up by all of this money printing. And as much as they say they're tightening, conditions are as loose. You can go on the Fred and see. Financial conditions are as loose as they have ever been, if not even more so. So that's one of the lies. But what you're also seeing is the severe overvaluation of all of these fiat money assets, stocks, bonds, and real estate, because everything has been converted into a fiat money trading product. Well, that's going to flip-flop, because right now what we're seeing with gold and silver is they're severely undervalued. And that changes when it is convenient for the central bankers, when they need to get the confidence of the public back. And then there's your opportunity. When these income producing assets, and we're able to see who's able to survive this mess, then they will be severely undervalued, while your gold and silver, primarily gold for this function, is up somewhere near its fundamental value. What we're looking for is a technical accumulation pattern, and then you take some of the gains you have, those fiat money gains in those assets in gold, and you convert it into undervalued income producing assets that, by the way, you cannot outlive, which is what a concept. When I first became a stockbroker, nobody ever talked about outliving your retirement assets, outliving your assets, but interest rates were substantially higher then, and circumstances, we were new into this most current fiat money iteration. So there's your opportunity. All of those overvalued, highly inflated assets will come back to undervaluation. The ones that cannot survive this mess will go away. I couldn't tell you which ones those are right now, because that data is so opaque. But as interest rates remain higher for longer, as the consumer becomes more and more fragile and is unable to support these highly inflated assets, you are going to see a major shift. And frankly, we're on the verge of a crash right now.
But it's hard though, right? I mean, I've been thinking, and I've been hearing really from people I talk to, that we're on the verge of a crash right now for a while now, and at the same time, watching the Nvidias and the other tech names, whatever it might be, being up hundreds of percents this year alone, and thousands of percents since I got involved in gold and silver. And so being on the sidelines because of this belief has been hard for me. And how do you reconcile that? How do you deal with that?
Well, first of all, you educate yourself, right? What we're looking at is wealth transfer in a major way, and that is perception management is a formalized tool of the governments and the central banks. And what it's designed to do is to nudge you in the direction that you want to go in. And do we not hear about FOMO, fear of missing out? When you're looking at the NVIDIAs of the world, which by the way, the insiders are cashing out in a rather large way these days. But when you're looking at what the insiders are doing with their stocks, which is selling it out, while the general public, hey, fear of missing out, it's going to keep going out up. What they're doing is misdirecting you into a false trend. The real trend is not in how high those stocks or those indexes can go. It's in the purchasing power of those dollars, because that's all you can convert it back into, right? If this has no value, then you convert your stocks into dollars, that has no value, right? That's the real trend. So the way that I stay constant with it, because I understand what it looks like and what it feels like, is I'm looking at the real trends. And the real true trends are not going to be discovered on Wall Street. That is a trading market, and it is designed to suck your wealth into it so that they're making all sorts of fees while you're taking all sorts of risks and you don't even realize it. The real trend is in the purchasing power. And the way that you and I know that, I mean, first of all, you can go again onto the Federal Reserve Education Department, and you will see that formally and officially, the true value of this stuff has gone down precipitously. The way you know it, regardless of what anybody says, is every time you go to buy anything. So not just food or energy, but medical care, insurances, clothing, cars, anything that you're buying. Are they costing you more, or are they costing you the same, or are they costing you less? Because we all know they're costing us substantially more, right? I have in here $1 trillion Zimbabwe note, right? $1 trillion. That means I'm a trillionaire. Do you know what I can buy with this $1 trillion Zimbabwe note? Not eggs. I can't buy anything with it. Zero, zips, zilch. So it doesn't matter what it looks like. The reality is, if you convert your stocks or your bonds or your assets into fiat, what can you convert that fiat to? Less and less and less. That's the real trend. So they're simply misdirecting you to go in this direction while the insiders are cashing out. Same thing happened in 29. Same thing happened in the 70s, 60s, and 70s. Same thing happened in 2007, 2008. This is the old playbook over and over and over again. And we are now, if you look at it, again, on the Federal Reserve Education Department. Look, do they fudge the numbers? Of course they do. They change formulas to make things look like one way, however they want them to. However, I do feel like they're being a bit more honest on that website than others. So if you go to the market capitalization, to the GDP, gross domestic product, so that's Wall Street versus Main Street, so to speak, what you're going to find is that it is substantially higher than it was in 99 before the NASDAQ crash. And now it's substantially higher. Wall Street is 100% taken over Main Street. And the thing is they have this tool called a printing press, and they can just create as much of this as they want to. This will run out. But as long as they have mechanisms to absorb more debt, they can create more of this. And the more of this that they create, the less and less and less value they have. And quite honestly, every time they do it, it has less and less impact, less and less stimulation, but it makes what you buy look like it's going up in price when in reality, it's the dollar going down. So I know enough because I've been doing this on sub level my entire life. I know enough to look at the truth, because how many times can you be lied to when you do not know the truth? Nvidia stock market going up is not the real trend. The real trend is the purchasing power of the dollar and all fiat money currencies. I don't care where you go.
Wife and I wanted to go karting this weekend, and so she likes preparing for everything. So rarely do we go to a place and just be like, "Oh, 2 tickets, please." We just prepare in advance, like, where is it? How much does it cost? And so she's going through how much it's going to cost, and having a drink before go karting or whatever, and all these things. And it was like 150 euros for the both of us for 15 minutes of go karting, and that's not like a fancy place or whatever.
Oh
And
my
so
God.
we're in Belgium, by the way. And so this is Western Europe. So prices were crazy. And I was like, okay, let's just take a trip to the mountains. We're close to the German, to the German mountains. I was like, let's take a trip there. And I was like, okay, how much is going to cost for us to get there? The gas that we're going to burn, and, maybe staying there for a night and then having something to eat. And it was like $500 for a week and 500 euros. And so you see that purchasing power disappearing. And you think of what a normal paycheck would be around here is like, I don't know, 2,000 euros or something along those lines. And you're like, so if I want to do a weekend of, go to the mountains and they go karting, and then maybe go to the cinema or whatever on a weekend, then half of your paycheck is gone. And I'm exaggerating maybe a little bit for effect, but that's the general trend that everything's moving to.
Exactly. Do you think that's going to get cheaper?
Nope, no way. There's no
So
way.
what is, and when they talk about inflation coming back under control, they're not talking about prices reversing. They are talking about the speed at which they're going up slowing down,
Hmm.
right? So there is real life experience in what you just said. And in the meantime, you're looking at the stock market and you're going, oh my God, why am I not participating in that? Right? Because after all, that's going up. And look at gold. Well, there's gold and then there's gold, isn't there? What you're referring to is the spot market. The
Hmm.
spot market are contracts. They are just contracts that are cheap and easy to buy and sell. And it's just about making a little pickup of money. And then some of the things like the ETFs that are created are, and people think they're buying gold, but in reality, they're buying shares of a trust. They have no access to the underlying gold. And the underlying gold is being sold off on a daily basis to pay all the fees. So let's see, you, the buyer of that ETF, are taking all the risks. You are believing Wall Street's value on gold, and it's all a big fat lie. The truth is right here in the physical only market, right? The raw stuff. So whether it's new bullion or this happens to be a pre-33, because I don't even own any bullion, to be honest with you. But something like this, or like, any kind of 1 ounce gold coin, right? You're not going to see what's really happening because it's very much guided by the spot contract market, buy, flip, and design. The collectible market, however, is a physical only market. And there we are seeing breakout after breakout after breakout. And actually, up in the rarefied air of ultra rarities, where there are coins that are like many millions of dollars for 1 ounce of gold, that's where you see the breakouts to new highs first. And they're trading at an all-time high. This area, because this is not millions of dollars, this is just, probably a few thousand. It's a rare coin. It's in the same category, but it doesn't carry the same price tag. That then had a second breakout, but it's still below the 2008 highs. So bargain, bargain, bargain. And this had to break out the slowest, right? So it's up where the one percenters play that understand what's going on, also called smart money. That's where we've seen the breakouts first. In this category, we see the breakout second. In this category, we see the breakout third. So you can actually use the physical only market to determine where gold truly is in this trend. And when you see global central banks buying more gold than they ever have historically, including the first quarter of this year, where they are buying more gold ever, which means they're probably going to break the records that they set in 22 and 23. What does that tell you? Who knows more about this stuff than they do?
Yeah. I actually, very good point there, because that's something I want to talk about, because I actually found a report today from the World Gold Council that showed the results of a survey that they did. It included 70 central bankers, and apparently almost a third, almost 29% to be specific, but almost a third of the surveyed central banks apparently intended to increase their gold reserves in the next year. And that may not sound like a large number to begin with, but it's the highest level since 2018. And now that's
Yes.
likely got something to do with the US dollars as a share of global payments, which about 2/3 of the 70 central banks that got surveyed, by the way, said that they think the share of the US dollar in global trade will go down significantly over the coming years. So
Yep.
talking about trends, what do you make of this trend? What else do you think is driving their decision here?
Well, it's geopolitical tensions. I mean, there are patterns that occur every time there is a currency regime shift. And I personally have studied currency life cycles since 1987. And there are just things that happen 100% of the time. And frankly, even though I can't guarantee tomorrow, if something has happened 100% of the time and we're doing the same thing, quite honestly, more than likely, we're going to get the same result. And what's really happening here is, I mean, it's withstood thousands and thousands of times, thousands and thousands of years. And at the end of the day, every single asset, every single instrument goes to its true fundamental value. You have to understand how to what that is, because Wall Street's definitely not going to be telling you until it's too late for you to do anything about it. But with, why was money created, right? Money was created, fiat money was created to take over for good money, right? Sound money, because sound money created restrictions on how much debt could be grown, what politicians could do, etc. They wanted to take that away from us, right? So in order to know the fundamental value of gold, you have to understand the fundamental value of the dollar. And you can see that easily by go to the FRED, FRED, in that search bar, put purchasing power of the consumer dollar, and you're going to see that we have been on a relentless march toward zero. And over 4,800 currencies like this one, Zimbabwe's now on their sixth currency iteration. We should talk more about that in a second because of their experiment. But ultimately, all fiat, all government-backed money goes to zero. That's its fundamental value, because by design, they inflate the value away to keep you in these assets, to rob you of your work, right? Because you get paid in this stuff. And in fact, a little while ago, I just did a little spreadsheet and I looked at in the US, the average wage was $10,290. Now, obviously I don't have this in front of me, so I could be off a little bit, but I'll be pretty close. If you had been paid in gold back then, that would have equated out to, I think, something like 285 ounces. Today, the average wage is something like $63,000 or something like that. And so most people would say, well, I'd much rather have $63,000 than $10,000. However, If you never got more of these, but you just got paid in the same amount of these, that equated out to something at the current spot, which is still undervalued, that equated out to something like $650,000. Could you manage to go on your go-karts and on your vacations if what you were earning were 650,000 euros or dollars or however you want to equate that? Of course.
Yeah.
But this inflation is what enables that wage and income inequality that we see. And when these markets get too expensive to support, like we saw in 1929, like we saw in 1971, like we saw in 2008, guess what happens? Boom, they're no longer supported. There is a major crisis that occurs, and they shift into the new currency regime. And let me tell you, I have discovered that there is a banking crisis that is unfolding right this second that you're not seeing yet. And it's in the fintech area, that these are financial firms or technological firms that have partnered with FDIC insured banks. And so they say all their marketing materials keeps talking about the FDIC insurance, which in itself is a scam because they don't have any money in there. However, people feel comfortable when you say, oh, well, it's insured. Well, guess what? That's a contract, and any contract is only as good as the counterparty to the contract. And as we saw with Silicon Valley Bank and the whole regional banking crisis, there wasn't enough money to bail everybody out, to take from the fund. So they still had to turn around and bail everybody out because they don't want people in this country, and I think in any developed nation, so certainly in Belgium, etc., they don't want you to realize that deposit insurance is a total scam and that your wealth will be bailed in like they tested in Cyprus. But they laugh about it because they know that my money in the account in the banking sector is sticky. In other words, you get a bank account and you don't leave. But what's happening right now is that a third party mediator between the banks and between other companies has failed. It's failed. And they had between all those fintech companies 10 million end user accounts, many of which are now, boom, locked out of their accounts and are discovering that they are not indeed insured because in the documents, the new account documents that you sign and agree to, it says that they can move your money once you deposit it into their accounts. And their accounts are brokerage accounts that are not insured in any way. And because of the ownership structure, right, with the big banks being the legal owner of any assets that are in there and you being a beneficial owner on the bottom and all those entities in between also being beneficial owners, that they were taking this money from one bank to another bank to another bank, and some were redeeming and some were loaning and some were doing this and some were doing that. And it's such a convoluted mess that nobody can discover. They're $85 million short in what they're saying so far, right? And nobody knows where that $85 million went. And since the banks can't reconcile, even the accounts that were insured, everybody's locked out. Everybody is locked out. Now, there are 20 banks so far that are embroiled in this mess. And since consumers, the end users, cannot access that money, what do you think is going to happen when they can? And if they can, they're going to go and you're going to see bank runs all over the place. What do you think is going to happen to the FDIC that has barely more than a penny for every insured deposit, let alone not insured deposits? And now what the argument is going to be Oh, well, these are in the smaller banks or these are in the regional banks. This is the kind of garbage that we hear. But guess who funds those smaller and those regional banks? It's the big commercial banks. It's the SIFIs, the systemically important financial institutions. So I can't sit here and tell you what is going to happen, but I'm telling you, you better own gold, period, because that's the only thing that's truly outside of this system.
Mm.
And this will protect you from that, period, end of discussion. So that's what's happening right now that you can't see. When do you want to know this? And I can't tell you when they're going to release those funds yet or what's going to happen. Nobody knows.
Mm.
Get
It,
to flipping safety.
it's here's what's weird to me with everything that's happening is that central banks and commercial banks, as you mentioned, and alternative economists kind of agree on this one thing. But again, even today, I read two articles where in one of them, some analyst of at BOFA, Bank of America, was predicting $35 silver by 2026, and then another analyst at Citi was predicting $3,000 gold within 12 months. Both predictions practically bearish by your standards, but it's that's not is that not making you nervous that central banks and commercial banks agree with you on the direction of precious metals at least?
That, no, it's not making me nervous. It's revealing the truth. They want to get to the safety of gold. They want to get to, silver. Silver for me is about barterability. Gold is about wealth preservation and then opportunity positioning. So I've been watching, actually, central banks stopped liquidating their gold in 2000, not all of them, but that was like the bottom where they had been selling off gold to pressure the price. And they stopped in 2005. 2005. Wait a minute, we didn't have the financial crisis yet, right? So these guys know what's happening and they're flying to safety. So it doesn't make me nervous about that because they're still working. Well, central banks are working in the physical realm. The bullion banks are also in the physical realm. Buy ETFs, they're the ones that can access that. No, I think it's more truth beginning to be revealed if you're watching. But remember too, on a purely technical level, in the US, because we've been watching spot gold make new highs in every other country forever, right? But what we saw in the US with the spot gold contract going up to a certain level, bumping its head, coming back, doing that again and again and again, because the forces of resistance at that level, and then it broke out. So, typically, you might see that happen once. You might even see a double top. A triple top is extraordinarily rare. A quadruple top, I got to tell you, I really have to dig to find that anywhere else. So there was so much buying pressure underneath of even those contract markets that boom, once it broke out, you can't deny that, right? And when you also have to look at the fact that we hit peak gold around 2018, which means there is way less in the ground to be mined than there is above ground, right? And the all-in costs to mine gold have been going up, and they're now at the highest levels that they've ever been, kind of putting a floor in how low they can push the price of spot. All of these indicators, so for Wall Street to be calling for 3,000 gold, which is chump change. I mean, do you want to know how to get to the fundamental value of any asset or instrument? It's not rocket science. It's quite simple. This is debt. This is how this is created. This is just savings money. So you take all the debt that's been created in the entire world, of which there is an unlimited amount, but where are we at right now versus how much gold there is in the world, because gold is indestructible and we can account for about 98% of it And again, the Department of the Interior comes out with an annual survey of how much in-ground gold and in-ground silver there is. And so what we know is demand, and gold is used in every single sector, so is silver, of the global economy. So it has the broadest base of functionality, but here's the point, the broadest base of demand. So if you have the inability to buy this, and not because it goes away, silver gets used up, but gold does not, it's reclaimable, right? However, once those central banks are buying the gold, are they selling it again? Only in a crisis. That's the point of it. It's a savings tool. But no, they're not. They're accumulating at the highest level. That gold is going off the market. And who even knows how much gold China's actually sitting on? We don't know. That's opaque. And if you think that the central banks are always telling us the truth, there is this bridge in Brooklyn that I'd like to sell you, right? Not really, but you get my point. So $3,000 an ounce? No. $30 an ounce or $35 an ounce for silver? No. I'm not waiting for Wall Street to tell me the truth. I'm not even waiting for the black market to tell me the truth, although we see that come into play, and we will see that come into play. I can tell you that, now I don't know what the coverage ratio is going to be, but that 1 ounce of physical gold in your possession is worth roughly 40,000 of these things right now. So that means that if they were to do those overnight resets like we've seen in many, many countries, Venezuela, Argentina, Zimbabwe, many other countries, right now, Turkey, I mean, I could go on, and Egypt, I could go on and on and on, right? If we were to do that right now and they did it on a 1-to-1 ratio, which is not typically what they will do, but if they did, you would see the spot market go to 40,000. And subsequently, silver, I think it's somewhere around 2,000. So $30, $3,000, bargain, 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 bargain. And especially these. And in the US, where we have a long history of confiscation, I mean, it's been confiscated 3 times. You know, I can't sit here and tell anybody that they are going to do an overt confiscation again, because there are many different ways for governments and central banks to confiscate your wealth. Inflation is certainly one of them. Suppressing the real value of these things is certainly another one. But we're seeing in Zimbabwe, who is now running this experiment because the public does not have any confidence in the ruling class or in the money. What they do, they did what they do every time. They put a component of gold in the new currency. But the problem is that the public is still quite skeptical because it's not convertible. In other words, you can't take a new Zimbabwe dollar into the bank and walk out with a certain amount of gold. And so, can you tell me that it's really there? But one of the ways that they're continuing to confiscate is by having all of the miners give them a certain amount of gold. I think it's 20%, but don't hold me to that. I don't have that data right in front of me. But I believe that it's 20% of whatever they're mining, because presumably the promise is that they will not print more than the gold and the foreign exchange reserves, this new currency, the ZIG, Z-I-G, they won't print more of them than what they have in reserves. I don't know if that's true or not. What I'm watching is, first what they did was they came out with a Zimbabwe gold coin so that the public could hold its purchasing power as they were in hyperinflation. Well, only the 1%ers in Zimbabwe could afford this. So let's make sure that they're covered first. Then they put it presumably in their cryptocurrency, their central bank digital currency had a component of gold in there along with a basket of currencies. And the public wasn't buying that crap.
Hmm.
Now they put it into the new Zimbabwe dollar. It's a basket of currencies with a component of gold. And I'll be darned if I can find what that percentage is and what other foreign reserve currencies there are, even going on to their central bank website. They have really buried that. So the jury is out and how accepted it is, but I feel that this is probably the single most important experiment that is going on today because they're the only country that's doing it. But they've been in hyperinflation since I think like 2006. I've been watching this unfold.
Yeah.
So, and this is their sixth iteration of that overnight revaluation. I
Hmm.
can't tell you how many we're going to have moving forward. I can tell you globally on average, it's usually 3, but I can't tell you what the ratio is going to be. I can tell you globally on average, it's 1,000 to 1 when they do that reset. What spot went up something like 3,600% overnight in Venezuela when they did the first one.
Well, but our financial systems are more stable than that, right? I mean, in the developed worlds, you'd expect at least or hope.
Are you kidding? Are you kidding? Why in the world would you think that they're stable? They're based on bets and debts and leverage, which is debt upon debt upon debt upon debt upon debt. So, and it doesn't matter whether you're a government, a corporation, or an individual, frankly, debt all works the same. And if it's you, let's say you have a credit card. And let's say for a while there, you're able to pay that balance off in full. So you're not paying any interest on that. You're just borrowing it for a little bit of time. But what happens if you lose your job or if your income doesn't keep up with the cost of that money? And all of a sudden, now you've got to carry that balance over a month, 2 months, 6 months, a year, whatever. And the interest keeps going on. And what if you can't pay all of that interest? Now that interest is going on top of your principal and you're paying interest on top of interest. You are compounding interest. How stable are your finances?
Hmm.
They're not.
It's true. Yeah.
That's where the global financial system, goodness gracious, is based on the 10-year Treasury note. What is a note? It's a debt instrument. It's a promise to pay. What backs that up? And everywhere in the world, it's the full faith and credit of the government.
Hmm.
Let's translate that. As long as you trust them, you have faith, you will continue to extend them credit, loan them money. So all of this is supported by a government's ability to create more and more debt. But I did a study back in 2009, and anybody can do it. You go to the Fed and you look at the debt, and you can go in there and you can go back to those spreadsheets. So you can go all the way back to when they started tracking this stuff. Because I said to myself, remember that was right after the global financial crisis. And at that time, the US deficit was about $1 trillion or something like that. And yet we were servicing at that time 13 trillion in debt. And I said, well, look, it hasn't been that horrible except recently because of the financial crisis. So if we're only $1 trillion or we're somewhere in that vicinity in deficit spending, in other words, spending more money than we have coming in, right? Why are we servicing 13 trillion in debt? So I went in and I dug, and you could actually see that what was happening was compounding interest. So when they report the interest on the debt, they're not talking about any of the compounding interest. They're just talking about, for this minute, this is how much interest we're going to pay on all of this accumulated debt. But now the US is like 35 trillion that we know of, because there's all different ways that you can report this stuff. And we're still at a 2 trillion in deficit spending, which is way worse than it was after the crisis. So Are you ever getting out of debt? If you're compounding your interest, you're not touching any of the principal, you're not paying all of the debt. Are you ever getting, how stable are you?
Hmm. At least it looks like that because we haven't had hyperinflation I suppose my time, and that's what makes me trust, I suppose, so you have more trust in the financial system, which
Right?
I suppose are lessons that you learn the hard way. One of the ways that I suppose
Have to be though.
what's that?
You don't have to learn it the hard way. There
Hmm.
is so much history and so many facts, and I am a fact-based decision maker. That's why on my videos, I give you the links. Don't take my word for anything. I don't make it hard for you to find it. I make it very, very easy because my favorite question of all is how many times can you be lied to when you do not know the truth? Do you really see any politician or any central banker whose job and that they take seriously is to protect the public, or is it to protect their own institutions and their own best interest?
Yeah, yeah, you're right. Uh,
Sorry, I didn't mean to
what
interrupt you, but yeah.
one of my favorite imaginary friends, Milton Friedman, tells me not to trust them in any case, so I don't. Um, did you recently interviewed Egon von Greyes? Good job on that, by the way. The great
Thank
conversation, so in depth, and so again, people can watch it on your own YouTube channel. Did you? What do you think of the whole dynamic between? And I want to talk about CBDCs here because CBDCs is starting to get very apparent with commercial banks in Europe now moving the route of their own digital coins and whatnot, and then um, potentially going into the same direction, which could be CBDCs or some type of a digital currency that we all use. While again, some central banks are stacking gold at that time, and not few of them are doing both. So they're stacking up
right.
on gold and working towards a digital currency. So what do you make of that whole dynamic? I think that's something you touched upon with Egon, although lightly.
Well, what I think is they're going to cram it down our throats during the next crisis, whether we want it or not. And what they're hoping is that most people will be unaware because if you're scared enough, whatever they want you to do, and if all of your wealth is held in this kind of stuff, even if it's digital, this intangible stuff, then you're going to have to jump. When they say jump, you're going to have to say how high. So I believe so strongly that we all need to be as self-sufficient and independent as possible so that when this happens, that we can say no. And the way that we do that, because I mean, markets can stay insane a lot longer than we would ever think that they possibly could, simply because of the tool that they have here. But that doesn't mean that things aren't happening. It means that they're just hiding from you what is happening. And in the tests for a number of central banks, right? They've given the population money. I mean, especially South Africa, I'm thinking they've put the CBDCs in and in South America as well. And what they're having a hard time doing, yeah, people spend what you give them, but then they're not refilling them. So the public is basically saying no. And presumably in this country, our politicians appear to be fighting it. I'm not sure that I actually believe that, but I mean, I see some that are trying to do it. But during a huge crisis, if all of your wealth is inside of the system, first of all, who are you going to complain to, right? Oh, you stole my money. Oh, too bad. And if you're dependent upon the government, if you're dependent upon the central bank, you're going to have to go along with it. Whereas if you create community, and frankly, Europe does this way better than the US, but if you are, we are running out of time. And you can see that because the biggest tool they have are interest rates. And aren't we hearing everybody say, well, this never happened before and this never happened before. So that's because we are at the end of this currency's life cycle. All of those patterns are flashing red right now. I just can't tell you the exact moment. But if you come together in local community to make sure that you have security in food, water, energy, security, barterability, wealth preservation, community, and shelter. That's the mantra. These are the things that you need to have a reasonable standard of living. And if we come together, we can help each other and give each other the ability to say no. On a global basis, we need to also come together in community for sound money. Let's have a very peaceful and quiet revolution simply by converting this stuff into this stuff. Garbage money into sound money. If we can get maybe 3% of the population to do that, we've got a shot at having a seat at the table in this new iteration of our money system. And we need to have that, because if we do not, if the world goes on a fully surveillance digital currency that they can push a button and lock you out, that not just this perception management nudging, but actually social scoring and repercussions for having a different opinion than they want you to have. If we don't do something to have a seat at that table, the world that our grandchildren, our children, our great-grandchildren are going to inherit is going to be taking us all the way back to the feudal system, where you just have a handful of entities that own everything and everybody else owns it. Well, I got news for you. That goes to the first question you asked me, which was about opportunity. How about you be the one that owns it? How
Why I'm
about
asking?
we create a quiet revolution?
Why I ask you about the relationship between those CBDCs and the precious metals is because I saw a claim online. It's not typically something I'd blindly believe myself, but someone made the case for this actually being an effort to suppress gold and silver prices globally,
Oh,
and that was the
100%.
main reason for the increase in gold purchases by central banks to then do something with CBDCs and suppress the prices of precious metals that way. I mean, is there a link that you can see or something happening, or is this more of a rumor?
No, absolutely. I can address that. Number one, I don't think it was an accident that Bitcoin came out in January of 2009 and quantitative easing, all of this money for free printing, came out in March of that same year. Now, imagine if all of those dollars that have gone into these cryptocurrencies had gone into gold. So yes, 100%, there's not one doubt in my mind that for many reasons, Bitcoin is a Trojan horse. They get a lot of eyes on it, and it's how they always make these transitions, is they let people win, and letting it go up has no intrinsic value, but letting it go up gets lots of eyes. And again, that FOMO, that fear of missing out. Having said that, they need adoption, and cryptocurrencies get people used to CBDCs, right? And they're coming out and saying, oh, private crypto's bad. Public crypto CBDC is good. I mean, it's all a spin. But do I think that they're going to use it to continue to suppress the price of gold? Yes and no. Okay. No, because they already have the bullion banks and Wall Street doing that with all of the contracts, of which there's an unlimited amount. And I can tell you, personal eyes, but before I understood print screen, that for every 1 ounce of physical gold, there were at that time reportedly 62,000 ounces of digital gold, right? That's enough to suppress a price. However, when all confidence is lost, then central banks need, first of all, that's how they do the revaluation. They take this that has no intrinsic value used in one place, and they revalue it against this, which is used in every single sector of the global economy. And so again, broadest base of utility, broadest base of buyer. So it's all intrinsic value, right? So also gold is in our DNA, right? No, you haven't been on a gold standard in your lifetime, and I haven't been on. I was quasi because I was born in '54, so a quasi sort of gold standard back then. But it's still in our DNA, which is why all those cryptocurrencies, they look like gold coins, silver coins, or platinum coins, right? It's because that's in our DNA, and we think about gold as being a very strong, powerful, good thing. So at the end of the day, to regain that confidence, that's why watching what's happening in Zimbabwe is so critical. They use gold. They've done it over 4,800 times, 100% of the time, because this is what regains the confidence. In the US, Roosevelt's fireside chat was about regaining the confidence in the banking system because the new money is backed by good money. Yeah, gold, the gold that they took away from the public.
It's interesting when you mention gold and silver, though, because listening to sort of your maybe your grim view of the world, where you say a crash, there could be an opportunity in it, but you say a crash is coming. So, wouldn't this thinking also eventually bring you to a spot of thinking that silver is not going to run in absolute terms because it's not only a monetary metal, it's an industrial metal too. And so with these things happening, there could be a slowdown in industrial demand, right? So how do you reconcile being bullish on silver and bearish in the economy at the same time?
Because I've done studies on how gold and silver behave through inflations and hyperinflations and deflations and all of this. And what you discover is, so many people talk about that gold silver ratio, which is really, really far apart because, to your point, silver straddles industrial as well as monetary. More gold does too, but silver does it much more. And what I found every time I did that study is you would see that gold silver ratio narrowing. And then once you get into the hyperinflationary state, since this is what they do the revaluation again, you see it growing wider. But what it does do is it maintains your ability to purchase the same goods and services. So for me, I have a strategy that I created just based on all those studies and those repeatable patterns. For me, silver is about barterability. Because if I need to go buy gas or groceries or something like that, I don't want to take my gold there. I want to take my fractional silver there. So in the strategy, because I think this is going to take a lot longer to work through, I have enough silver to accomplish what I need to accomplish in sustaining my standard of living for 10 years. But without a doubt, the lion's share of my silver is in this. And this is a collectible because it's more rare. That's where you're seeing a lot more honesty in the markets. And I hold emergency in this and barterability in this. So it's the right metal for the job. And that's why when we're working with a strategy and working with a client, what we look to do is establish what their goals are first. What are you trying to accomplish? And then we work back from there. A lot of people will just randomly buy gold or they'll buy silver because of that ratio, gold silver ratio, and they're treating it like a trade. I don't treat it like a trade. So that's how I reconcile it. I treat it as a functional asset that I will use. And we've seen that happen many, many times where I'll use it as a tool of barter, direct barter, because during hyperinflation, for a minute, everything gets real, real local. So that's why also community is really important. So everybody knows each other, trusts each other. You're bringing skill sets together. You're bringing whatever, whether it's intellectual or it's physical assets together to help everybody survive. But it's also definitely, for me, it's a tool of barter.
Mm. When you talk about opportunities in these things, as this is happening, you don't necessarily have to treat it as a trade to think that way, but one opportunity to leverage what's happening would be gold and silver stocks. And that's what I'm building, if you will, my career on, is understanding, understanding geology and all these things and getting a little bit more of a specialized knowledge on these things, hopefully over the years that are to come. But how do you? I know you're not a fan of stocks generally, but it seems like a good way to leverage what you think is happening with at least a small portion of your portfolio. What do you think about that?
Well, I think that number one, everybody needs to do what they're comfortable doing. I have lived my life on some level in this arena as a stockbroker in the 80s and 90s, and, as a banker before that. So, uh, to be perfectly honest with you, gold and silver stocks are stocks. You don't really own the underlying gold, and it has yet to be mined. And therefore, when you convert those stocks, this is all you can convert it into. So, and I don't know, like we said, we're looking at not just Zimbabwe, but a number of countries that have put different levies, different fees on top of gold miners, and so are actually mine national or natural production resources, and taxing those in different ways are a form of confiscation. So at the moment, that is not where I'm putting my money. I'm really all in hard. I don't own any cryptocurrencies. I don't own any stocks or bonds or annuities. I do have cash because that is our tool of barter. But I only have a certain level of cash because I'm running a business and I have to do that. I have a chunk that's completely outside of the banking system so that I can always meet payroll and I can always make a deposit. But that's it for the fiat money assets that I personally own.
Right.
This is not the time to be leveraged, and I don't really think that that's the way to do it. And I can also tell you, in the 2008 financial crisis, because I have comparisons between the spot market, the collectible market, and gold mining stocks, that they don't really perform in a crisis because they're stock. They're not the safety metal.
Mm.
Sorry. And I love gold miners and I love gold mining, but yeah, not at this moment.
Yeah, that's one way to put it. Lynette, thank you so much for doing this. I don't want to keep you all day. I'm already not being as respectful of your time, so I'm gonna at least try and do that here. I always do enjoy our conversations. I could talk to you for hours, and for people listening, this was Lynette Zang of Zang Enterprises, and that's LynetteZang.com. It's also Lynette Zang on YouTube. She does a bunch of videos on there, so you can watch that. There maybe it's gonna be linked in the show notes or whatnot. But Lynette, again, thank you so much. I'll let you drop off now as I will move over to actually do look at some precious metal stocks in this Real Money Talks episode this week. So this is gonna be the CEO barbecue portion of the video, but I'm not gonna go into that before I've given you the mandatory honest confession and an important disclaimer. There is a warning on your screen right now that I will need you to read. It is not just some disclaimer, it's an actual warning that will help you not lose money. Okay. Because it's no secret I try to be different than other channels out there by not hating the viewer. And what that means is that I want to bring it to your attention. This is a very risky sector. And I also want to bring to your attention that I am here to make money with this channel. At Resource Talks, we make money by charging companies for content creation, basically. So some of these interviews that you're going to see on the channel, most of it are not paid for. Most of it are coming out of interest, but some of them are going to be paid for. So one of the interviews that you're going to see in here, specifically O3 Mining, is a paying client of Resource Talks. They pay us for content creation. And the Resource Talks interview rules are simple, though. There's no questions off the table. There's no questions that I send the companies up front, and there's no editing rights for the companies. But even still, I need you to understand that these companies probably see their participation in these conversations, in these interviews, as a chance to do some marketing. So just approach that from that perspective. But also be aware that this is not the only channel that does it. Okay, other channels who interview CEOs or talk about public companies or talk about these things, these channels typically earn money by charging for the creation and publication of interviews. Even though, again, most will not be as vocal about it, or maybe try and get away with it with a small disclaimer in the description only or something like that. And so some of them will unfortunately make buy or sell recommendations. That happens a lot. There's people out there who take money from the companies and then turn around and tell their audiences you should buy this company because it's a good company, right? Not going to happen here. We don't make recommendations because there's clearly a conflict of interest. Many out there will do that, and so be aware of that. And anytime you're watching any type of company specific content, just approach it as if you're watching an advertisement. And if you're feeling good about yourself, maybe use your brain while watching it too, because again, this is a risky sector. And although I try to do a decent amount of research, um, this still should be seen as advertisement and not as research, at least of those recommendations. That's it. None of us know what we're doing, as I always like saying. Otherwise, we wouldn't be making videos for the companies. We'd be investing for livings. There are no guarantees here besides that that investing contains risks, but also that there will be forward-looking statements in these conversations. Those are conversations that are general and impersonal in nature, and they're containing people's hopes for future events that may or may not take place, depending on a bunch of different stuff, many different factors, oftentimes outside of your control and outside of the company's control. So be aware of that, and please talk to a professional investment advisor, and please do more research before taking any decisions in the end by visiting setterplus.ca, which is where the company's official filings are available. And again, there are disclaimers on your screen right now. These are going to be general and impersonal conversations that you shouldn't rely on. Please, if you don't enjoy losing money, read them and be careful out there. With all that said, though, as I just alluded, I am going to start off with the first company, and then I'm going to have to travel to Canada, Val d'Or specifically, or the Valley of Gold, that is, in Quebec, where I'll be getting an update on O3 mining from CEO Jose Visquera, because it's been a while since I've had one. The company is listed as O3, but then it's Roman 3, so it's OIII, technically, I suppose, on the TSXV in Canada, where an average of about 50,000 shares trade each day, with a 52-week high of $1.72 and a 52-week low of $1.03. With a market cap of about $100 million and about 88 million shares outstanding today, this is a $1.12 stock. Management owns about 5% of the company. Over 20% is owned by Osisko Mining, and another over 30% is in the hands of institutional investors, leaving less than half of the company in the hands of retail investors. Looking at the latest balance sheet, which is dated March 31st, the company had about $37.5 million in current assets, over $15 million of which in actual cash and cash equivalents, and about $21 million in the form of marketable securities. Those would be specifically shares and warrants of other public companies, which has notably increased from about $7 million at the end of last fiscal year to about $15 million increase in marketable securities in 3 months, is something I hope we can touch upon later on in the conversation. Current liabilities show me about $6.5 million, mostly in account payables, and the long-term debt is mostly represented by a $6.4 million convertible debt, which loyal viewers and listeners of the channel will remember carries a 10% fixed annual interest rate payable semi-annually, half of which can be paid back in cash and the other half payable either in cash or shares. It's up to O3 to decide. That same financial statement also tells me that on average, O3 spent about $550,000 a month on administrative expenses, which is a little bit higher relative to last year. Whereas on average, $2.8 million was spent on exploration and advancing the company's assets, over 85% of which, of course, was spent on the flagship Marble Alliance project. To put it simply, this means that, again, the company spent about $10 million over the last reported 3 months, 3-month period, less than 20% of which on administration and paychecks and so on, and over 80%, close to 85% on exploration and evaluation. As always, though, please understand that this is nothing but a snapshot in time, in this case specifically at the end of March of last year, and please head over to the company's website as well, setterplus.ca, to look at all the numbers yourself and make sure you're getting the full picture. I'm not doing a full asset overview here as I typically would, because Jose and I have spoken about O3 a lot, so I'll try to link to some of these previous videos somewhere in the show notes. But Marble Alliance is the focus here. As I said, it's located in the Malartic gold mining camp. It's about 12 kilometers away from Canadian Malartic. That's the gold mine, the big gold mine in the Valley of Gold. This is an advanced stage project. It's between the PFS and the FS stage, and the 2022 PFS, which was done at $1,700 gold, shows an NPV5 of close to $500 million, a post-tax IRR of 23.2%, which with an assumed annual production rate of about 115 ounces of gold and an all-in sustaining cost of $882 per ounce, results in a payback period of 3.5 years for the $435 million initial capex. All of this sounds promising. Again, considering that this calculation was done at $1,700 gold, which with the current rise in gold price is about a 30% discount to today's gold price. Yet the stock is down on the year, and this actually it's probably not the most fun part to start with, but Jose, it's one of the first touching points that investors have with a story. They hear about the story here, they open up the chart, they see the stock price going down. What's happening? I mean, is this a result of the Lassonde curve doing its thing, or like what's happening here?
Well, we should certainly ask Mr. Trudeau because he is the one that decided to pass this law where capital gains were going to be taxed at a 50%, and it would be in effect as the 25th of June. So clearly, this is a moment where whomever was making money has decided to sell all the shares and probably rebuy it after. But that has created a lot of uncertainty in the market. And it's not only us, like you can see many other companies had this drop, especially in Canada. And that is because of this new regulation. So this is an example of how much the destruction of value can be done by a government who do not care on people that actually are working day by day. They don't care about the doctors. They don't care about the teachers. They don't care about the people that are actually working on a day by day. This is made to make more money. Yeah, in the short term. But this is like the example of a company making 10 shares. I make 10 shares. I pay a tax. I can decide to increase the tax. And then you'll have to fire people to do the 10 shares. Or you allow them to build 20 shares. And then they will be paying you more taxes because they are building more. So we're focusing more on adding taxes in Canada rather than providing the flexibility to do more. And in my view, it's very clear that what has happened right now with O3 mining has to do with the taxes that will be implemented as of I think it's 26th or 25th of June of this month.
Yeah, that's an interesting discussion. I've heard about it before as well. And I'd be interested to see how everything goes after the summer, because in the summer times typically things slow down a little bit, and what happens right after that. But then right after that we go into tax loss selling season, and it almost seems like it's always something bad going on for our sector.
Yeah. Well, I mean, the only thing I can do as management, as CEO, as one of the largest shareholders of O3, is to go back to the market and buy shares myself. So at least I can give the view to our investors that I believe in the asset, that there is nothing that has not been said or nothing that is going wrong, but rather I am reinvesting my money. And I've been buying in the order of 25,000 shares in the past couple of days, and I'll continue to do that because that's a way to show my investors that I am as committed as any of them.
I suppose it's also, as I alluded to at the beginning, part of it might be because of your positioning within the Lassonde curve right now. It's sometimes called the boring phase of the Lassonde curve. So this actually might be worth an update because you decided to delay the feasibility study earlier this year. Talk to me about that. Why delayed? Where are you now in the process of commissioning the study, and how do you see it going forward?
So that's a very good observation. The Lassonde curve clearly states that as you have de-risked the project, we will start to see the share price coming down. And then after it levels, it begins to go up once you have financing. And that's more or less how it operates. In our case, we have gone from 1.6 million ounces to increase the resources to almost 3 million ounces, effectively 2.9 million ounces, from knowing now the metallurgy, from converting everything from inferred resources to measured and indicated, which means that we have drilled it every 35 meters. So we're very certain, like the amount of de-risk that we have done is substantial, which is extremely important to note, because what is your first line in any business is revenue. That is the amount of tons, we know exactly what they are. The grade, we know exactly what it is. It's around 0.97. We know the recoveries, and we know the gold price, which now is great. That is done. Then comes the operating cost, which in our case, in the pre-feasibility, showed around $900 per ounce. Effectively, it's 880 something. So $900 per ounce to make it simple. And the last part is CapEx. And the CapEx for us is $435 million based on the pre-feasibility study. However, if we put in consideration what is going on in the camp, in Val-d'Or, in the Valley of Gold, we realized suddenly that there is an opportunity to work together with other of the actors in the camp. Meaning by that, Agnico Eagle at Canadian Malartic, which by the way has a 60,000 ton per day plant, and they are going to be moving to 20,000 ton per day because they're moving from an open pit to an underground, producing the same amount of gold, but they will have an excess of capacity. Now it'll be their decision if they really want to work together with the junior mining companies and really show the will to generate more value in the district or not. And in that regard, we decided, well, let's see what they can do. And let's see if we can get into conversations, an arrangement where they can process our ore. So why would we do a feasibility as a standalone project when it is publicly stated that they will need feed for their mill? So we decided to wait a little bit to see how this could play. At this moment, we have waited now for several months. And we have decided that if we cannot get into an agreement, or at least to see that things are really moving by September, then we will just go as a standalone project, either only by us or together with others, because there is other companies in the region. I mean, Westdom is there, El Dorado is there, Probe is there, Cartier is there. So there is an opportunity to put things together and make it bigger. The reality is that we need to work together in this industry. To build a mill for only Marban, I think will be not the ideal situation for the industry in general. I mean, philosophically, I think that this industry needs to change. We need to show the market that we can work together. We need to show the young generations that we can work together. We can show the young generations that mining adds value and that mining is there for a change. So, I mean, that's one of the main reasons why we decided to push the feasibility initially, and now we'll just have to accelerate.
Those are a couple of interesting points there. So on the mill thing, I want to touch upon later on potentially working with other companies. I also want to touch upon later on. But in the meantime, since you and I last spoke, Jose, you've also been getting some assays back from the drilling that you had done. Are you thinking, let's see what this drilling is going to result in, let's follow up this drilling and then do an updated PFS, or even, I mean, I don't know, go to an updated PEA and then go through the process again? Or do you think you just put everything into an FS eventually?
Well, right now we have been converting all what goes into Malartic Age. So we have added another 300,000 ounces. If we see the history of O3, every year we have been adding around 250 to 300,000 ounces every single year. And last year we came up with this sort of discovery. It was there was a lot of historical drilling that we put it all together, and now we're drilling it to convert everything into measured and indicated. We have an internal study that is a quasi PEA, where we will have to evaluate if it is better to put a PEA out or if it's better to just go to the feasibility. We will not do an updated pre-feas. Either we do a PEA which is kind of going back and then back again into the feasibility, or we'll just go directly to the feasibility and forget about the PEA. Now, the beauty of the PEA is that it will highlight the new resources coming out from Malartic Age, which is effectively allow us to show the market that we have at the very minimum with that new deposit, another 2 years of production. And every year of production, we generate around $100 million. So, I mean, this is really how fascinating this industry or how frustrating it is, depending how you want to look at it. I'm a very positive guy, so I'm always looking at the positive side of things. We have a book value of over $200 million for a market cap of $100 million. And we have a future production, assuming that we begin production by, say, end of 2027, beginning of 2028. And if we bring everything to the present at a discount rate of 5%, we will have $1 billion in net present value at these gold prices. And the company is worth $100 million. So from a fundamental standpoint of view, this asset is super robust.
Are you guiding anything in terms of size as to the final FS of what it's going to be once you include Malartic Age?
We know internally that we will have at the very minimum 2 more years. We are working right now on redesigning the pits with more information that we keep getting. What are those information? So, for example, for the past year and a half, and it seems like it's not important, but it's really important. For the past year and a half, we have been working on specific gravity. What is the gravity that we're going to be using on the overburden? That allow us, what is the size of the overburdening as well? So that allow us to realize, well, on the pre-feas, we assumed that we had like 35 meters of overburden. Now we know it's only 10 because now we have drilling. Now we know how much it's going to cost us to take that out because we know it's not a very hard rock. We also know that the rock, that when you actually hit the host rock, is a very solid host rock, which allow us to have more steep pits. So pits are not going to be so shallow, but going to be a little bit more straight, and which is like 80 degrees. Of course, we're not talking about something huge. In some cases, 65, depending on which part of the pit it is. And that will allow us to gain some more ounces. I don't know right now the exact number, but I can estimate based on my experience that if we have right now, say 10 years of production, I would not have I would not be surprised if the engineers comes back to us saying that we have 14 years.
But that would mean, I mean, to achieve that, it's also improvement on the strip and potentially doing it at a different cutoff rate.
Well, could be an improvement on the strip, or could be the same strip and you're just extending the mine life. So there is always this balance, no?
Okay.
But I will assume, in my best estimate, that the feasibility will be an improved feasibility from where we were with the pre-feasibility.
Does that put you in a different ballpark for the permitting timeline, though? Do you have to go through anything more than you would typically have to go through?
No. What guides the permitting right now in Canada is the throughput. So if you pass the 5,000 tons per day, then you have to go through provincial and federal. So we are in that position in any case because we will need between 15 and 16,000 tons per day. So that already put us into have to permit this in the two levels, no, provincial and federal.
Okay. What's a typical timeline to go through that process? Is it 18 months or something like that?
It takes up to 2 years, 18 months to 2 years.
Okay. Well, that makes sense. Sure. How's the environmental base study coming along? I believe you were going to be doing that, or?
Yeah, we submitted the initial I say study, and the way it works is you submit your study, and then the government will consult and will give you a whole lot of questions after that. and you start solving those questions as you go into your feasibility. And it's not until you actually file the feasibility that you get the final question. So right now, what we are is we are already working with the different actors, if you want to call it, that are involved, First Nations, citizens, population in general. We have even opened a specific place for community relations. So if anyone has any questions, they can just go there and ask questions, or if they have any concerns. Hey, like what is going to be the amount of dust? What is going to be the amount of noise? How much water are you going to use? Where are you going to bring this water? Is this water potable water? Is this water dirty water? Which, I mean, all of those very, very valid questions. Are you going to do ancillary facilities for a road? Where is your road going to be done? Well, we don't like the road how you have placed it. Can you place it somewhere else? And if there are things that can be done, we will do them, because it's in our own best interest to have everyone involved and everyone to believe in the project, in the asset.
What's the feedback you're getting? That's an interesting point that you've already set that up, because that's not something you had to do. You're doing it sort of as a precaution. If you, what's the feedback you're getting on that from the community?
We're getting great feedback. We're getting great feedback. We're getting a lot of good suggestions as well, as it should be. We have also decided in some of our properties that are on the eastern side, outside of Marban. We had some properties that were in the town of Valdor, and we decided to make a compromise with a public compromise that we will not be doing exploration there, because there was the golf course, there was the first order waters there. There was some forestry around and some trees that should not be touched. So, all these little actions creates or generates trust at the end within the community, which is very important. No?
Sure. And you are very active on the community front and just generally ESG front. I saw you won an award at PDAC. I was actually at PDAC this year, and so I saw the banner when you entered the arena. You can see the banner and all that, and that got me thinking. So I understand that it's important, but at the same time, I'm wondering about the cost benefit analysis from a company perspective. Like from your perspective, how is there really a big additional cost to being so focused on ESG, and what's the cost benefit on actually being that focused on ESG?
With regards to ESG, I think at the end it is cost benefit, but I think the benefit is way bigger. I actually don't think about ESG. I think about doing the right things. Now, when you do that, there was someone very smart that has called it ESG, but I mean, I think it's good practice to focus in environmental and social and governance. Right? I don't think anyone will be able to do something like doing damage to the environment, or someone like not following governance, or someone like not caring about people. And maybe you get along the first 2 years, and then it bites you in the head. So, again, it's a term that has been called, sometimes abused in some regard, but we take ESG of what are the right things that we have to do to have a project that will last in the long term. And that's it. You can call it ESG, you can call it responsibility, you can call it management responsibility, any way you want to call it. Do we care about First Nations? 100%. Do we want to be okay with the citizens? For sure. Do we want to give them the opportunity to tell us what they worries are? Of course. You need to know where where you are going to be standing. 3 or 4. Do you want to have proper governance on what are the process that we're going to follow? For example, one of the things that we are doing, we know that we will have to buy some houses. We have set up a protocol where it states that everyone will follow the same action, 1, 2, 3, 4. And the valuation will be done in that particular order. So tomorrow we will not have anyone say, oh, you paid more for this guy than for this other guy, or why you're not paying the same to me. It's like, no, here is the same rule for everyone. So that avoids tomorrow to have a significant issue. The same thing with regards to conversations with the First Nations. What is important for you guys? Listen, we do not have to have the same objectives in life, and that's okay. You know, some people feels that, you know, the value of purpose is different for you than for me. The value of meaning is different for you than for me, and will be different from the First Nations in what is important for them. So it is important to understand where is everyone coming from, so you can actually put things and make them work.
It is, those are important things to go about. And with you, it's also, I mean, resulting in you just getting better recognition for the ESG efforts that you're putting in, again, multiple awards and stuff like that. So it's good that you're thinking about these things. I think it also just makes it easier for, if you want to make a big hole in the ground, it makes it easier if you did the right thing since the beginning. It's easy to get a yes on that. So let's
1,000%.
let's go back to exploration though, and growing this thing here for a second. In your latest MD&A, you mentioned that you're planning on spending about $400,000 on additional exploration and evaluation activities a month, specifically focused on resource conversion. What is that? I mean, it was a short note in the MD&A, but a significant cost. Can you sort of give me a breakdown of that cost, of what exactly you're going to be doing?
Well, significant is it's an important word. So we pay around $200 to $250 per meter of drilling. I mean, drilling is expensive. So, you know, you do 1,000 meters is $250,000. And 1,000 meters doesn't convert resources. So you need 4,000 meters to really start converting some resources. And what it means is that, again, we're drilling this every 35 meters. So if there is a hole done 60 meters apart, if we don't have the hole in the middle, it's not indicated. It's only inferred. So we have to do that hole in order to put it into the mine plan. Otherwise, it will not be counted. So it's kind of a tricky situation in a sense, because if we were mining this and we were not a public company, we would not care, because you know it's there. You're gonna mine it anyways. But if you want to include it into a study, if you want to show a feasibility study with that area or that block being processed, then you have to have it at 30 meters apart or 35 meters apart.
Right. Where exactly are you drilling? I mean, you're going to...
So we have Marban. In the case of Marban, in the outsides of Marban, we have a couple of little pits that now we're trying to join them to make it only one bigger one. And then as we go towards the northeast in Quirenza and Nolartic, we're still converting.
But is it that includes Kynebik or Kinebik, or like how do you pronounce it?
Kinebik is outside of Marban. Kinebik is on the Cadillac outside of the Cadillac Lake break. Kinebik is in the break of Hecla. So that's one break on top of Cadillac break, and Kinebik is an area where we are drilling for discovery, really. So we have done all the exploration work. We have done all the geophysics, the geochemistry, and now we have to plant a couple of holes to see if we can have something of significance in the Casa Berardi break.
Okay. How much do you want to drill there this year?
It's a plan. I believe it's for 4,000 meters.
Okay. And then outside of that, is that the only spot where you're looking for new discoveries?
Well, at Marban, we have three main faults. So cortical structures, cortical meaning there are deep-seated structures, almost like the San Andres fault, but with differences, because this one is up and down and not slip side. And it goes from Quina at West Dome towards the northwest, the three of them. And this is like, you don't even have to be a geologist. This is just common sense. We have been finding all the deposits along these structures. So there is a couple of things that are important to mention. One, we have the right host rock. Two, we have the right fracture to allow the fluids to come up. And more important, we have the gold. We have the mineralization. So once you have the host, the fractures, the gold, now you need to allow to precipitate. And in this combination with different chemical elements that are in the host rock allows to precipitation. So we have been drilling systematically going northwest. Of course, at this point, we are just in a position of saying, okay, we're going to do one more drilling on the Parforu, which is on the western side of the cortical structures that we have in there. And why are we drilling there is because there was previous holes from the 1990s that showed high grade. So if we end up finding high grade there that eventually can go to the mill first, then we'll take that for sure. But we're not doing more drilling right now on finding new areas for open pit. Why not? Because it will take too much time to convert. And two, because after 15 years, when you start discounting everything towards the present, so that means that you imply into that the cost of capital and the interest, right? So you start effectively doing 1/1 plus I to the year. When you start doing that operation, after year 15, you don't really affect the net present value. Like if you think about it, like the first year is a 1, the next year is a 0.9, a 0.8, 0.7, 0.6, and then you end up in a 0.1. So 0.1 times 1, like you're not really incrementally adding value to the asset. So we're very cautious on how do we spend our money. So we want to impact the NPV. We want to impact the actual fundamental value of the asset.
And that includes for you, that's why you're focusing on Malartic H, or you were focusing on Malartic H, basically.
Yes. And also, so the way we look at O3 is we have fundamental value, which right now it's around $1 billion. Simple as that, as a net present value. And if gold continues to rally, we'll be just higher and higher. You're only buying an option. And we want to have the option to find a new deposit. And that's what we are doing in Kinnebek that you just referred before. So if we have a new discovery, I think that would be the best thing that could happen, because that's the only way how a company like ours, which we are, as you alluded, in the bottom of the Lassonde curve, we could have now an asset which is going to be on the top that will continue to go up.
Okay. So it's essentially skipping the Lassonde curve. But do you think that the market is going to care about a new discovery and it's going to give you a value for it now?
I think if it's a new discovery, probably we will get some value. If it's a huge value, I don't know. But imagine that we end up hitting, I'm talking about a dream, of course, but 100 meters of 3 grams gold and 1% copper in this area of Kinnebek, which is a VMS camp, which could happen, then anyone will pay attention.
Yeah. I think at that point, you maybe stop caring about the market, actually. Maybe you care more about your neighbors and who else is watching you. But that's something we can touch upon later on as well. I mentioned Malartic H here a couple of times because I also wanted to ask you about these recent intercepts that you had, because some of them came back with there was some decent variability. There was some width variability, but there's also some grade variability in them. Is that unique for that part of the world? Do you know how to deal with it, and how do you deal with these variabilities?
Well, the easiest way to deal with the variability is just drilling more. And once you drill more, you have a very clear idea of what is going to be the regression and the progression of the different assays, no? So you will have a better idea of the distribution. So it's as simple as that. It is great to have high grade, but you well alluded. I mean, now you will have to be more cautious. Yes, of course. And that's why we have to drill more, to have a very clear idea of how the distribution is.
Okay.
We will have higher grades for sure. we'll probably have more ore than what we think we have right now. But we need to do the full drilling. And why do I think that we're gonna have more ore? Is because we're gonna have a lot of capping. So a lot of the values that we get in those assays will be capped. For example, if we had like 100 grams, they probably will cap it at 50. So there's a 50 that will not be included,
How
and
much
that's
more?
okay because we have to be very, very, very conservative at the end.
And being conservative just basically means more drilling. That's what it comes down to, as you said. How much more drilling specifically?
I think right now we have another 5,000 meters more that we have to do. Like not that
Okay.
much more. We're
Still to
already
be
most of it is at 30 meters apart. So
okay. So yeah, again, as mentioned, very close. Do you have that's 5,000 meters that is still to be drilled? That's not assays that are pending.
no, it's to be drilled. Yeah.
Okay, but I mean, all the assays from the last drill program are released, right?
Yeah.
Okay. When do you go back to it? When do you restart drilling?
I believe we're starting in July and we should be ready by August with all the drilling, and by September we'll have all the results back.
Okay, that's Malartic H specifically. That you're not taking. You're not talking. Kinnebig.
No, no.
Okay. When do you go to Kinnebig? Because you said 4,000 meters there.
In the end of the summer, probably around August. We have
Okay.
reduced our team, so we have to use the same teams from one side to another.
Oh, that makes sense. Well, yeah, I suppose it makes sense for the actually might be a good point to talk about costs too, because we count the field costs, the G&E costs, the exploration costs, and the study advancement costs. To my calculations, based on that last MD&A they published, that puts you at about $14.5 million budget for 12 months between March 24 and March 25. Um, March 2024 and March 2025. You have a sufficient cash position to cover all that right now at $15 million. Do you foresee needing any more capital in between?
No, 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 not at this point until we at least start the feasibility. No.
Okay. But also, as I mentioned, at the end of the last quarter, you had a very sizable marketable securities position.
Mhm.
What's that? What are those marketable securities, and would you treat them as cash? Is that strategic, or can you
No,
talk
we
about that?
unfortunately, well, I guess you can trade as cash, like half the cash, because there is no liquidity in those securities, right? So when we sold the first, when we gained the first bucket of securities, if you want to call it, was when we sold strategically our Garrison project to Moneta Gold.
Hmm.
And why we sold it? Because they were just besides each other. So it was two PAs, one PA with $400 million, the other PA with $450 million. So we felt, well, if this is a combined project, now you have a combined project of $900 million. And they did extremely well. Like Moneta ended up being like $400 million market cap. And then the market lost the appetite in Moneta, and our stock came down. And now we have 14% of Moneta. Do we want to sell it? No, I think Moneta is big enough that can be taken over anytime.
Hmm.
So if gold continues to rally, bigger companies will look for assets that has significant amount of ounces, meaning by that over 10 million ounces, and Moneta will be one of the first ones to be acquired. Then we can monetize our position. Selling it right now, I think will destroy value for O3 rather than add value.
Hmm. Moneta is not. I'm looking at the stock price of Moneta. I mean, they also have not been doing well, unfortunately. It's over the last 2 years. It's come down 90%.
Yeah.
Yeah. What do you think is a fair takeover price, by the way, for Moneta? We can speculate a little.
What will be the takeover price?
Yeah.
I mean, right now, if you see previous transactions, I don't think there is a lot of transactions that have been paying more than 35%. But I don't think Moneta right now it's at that time of their life. I think they need to show more before we think about any M&A. You know, if someone wants to come right now, it would be the worst thing ever.
Hmm. Yeah. That's one other point actually that I wanted to ask you too is that you're sufficient and you have a sufficiently strong share structure where, again, as I said, less than half of the companies in the hands of retail investors. But how do you protect it? How do you protect the asset? Which you think I can see that you're kind of frustrated with this price in the market that are at right now. Like you're $98 million market cap. You don't like. I mean, you think that's too cheap. How do you protect it from someone else who thinks it's too cheap? Someone else who thinks, oh, this is an asset that I think, like you do, it's worth $1 billion. I can pick it up for 10 cents on the dollar. How do you protect the company from that?
Um, well, right now it's easy to protect it because in order for someone to take you over, if they want to do it on a hostile way, they need 66 and 2/3. So between Osisco and my family, no one can do anything really. But the reality is that at this moment, shareholders may prefer, a liquid stock than our stock.
Mm.
So, I mean, that's part of being a public traded company. You are subject to that at any time. And smart companies will take advantage at these levels. Now, the history of mining, unfortunately, or fortunately for the smaller guys, has never been like that. Has never been them taking over when the companies are doing bad, but it's always when everyone has gained so much confidence that then they do a big buy. I don't know if you remember, there was a big M&A case with Goldcorp buying Andean in Argentina.
Mhm.
And, Goldcorp had the opportunity of buying them 4 years in advance for $100 million.
Yeah.
They paid $3.6 billion.
Mm.
Goldcorp had the opportunity of buying Osisco at the time for $3 billion. They decided for the first time ever to do a cheap bid and end up losing the asset to Agnico and Yamana. So I don't think I do know why that happens, because big major mining companies wants to have a very robust share price to do that. But while you're waiting for your share price to be super robust, the other guys are getting robust as well.
Mm. And they like more de-risked stuff, I suppose, too. So the more you de-risk it, they don't.
Absolutely.
Mm. Yeah.
Absolutely. I mean, I don't think any major companies want to take all the hassle of permitting and all that. If someone will do something, we'll be after that.
Mm. I know the last time we talked, you told me you'd like to actually build the mine yourself. Going through this tough period in the market, is that still your sentiment and intention? Do you still want to build it yourself, or would you start looking for a buyer anytime soon?
Well, that's my dream, to build a mine. Right now, having a mill that is only 6 kilometers in straight line and by road 12 kilometers from us that can process the ore will be the ideal scenario. But again, by the 1st of September, we'll have to look for different alternatives. Either it goes there, or we find somewhere else, or we can also sell the company.
Mm.
There is no reason why you would not look into that as well. We're here to maximize value to shareholders, so that's the only thing that is important.
It, I'm glad you're mentioning the mill there, because that might have come as a surprise, because since, again, last time we spoke, you've terminated the option for the mill, and again, it might have come as a surprise to some people. Can you expand on the general thinking or the strategy, the corporate strategy behind that decision? How does it make sense to start divesting from some of these assets?
So we had an option with QMX, which was a company that subsequently was bought by El Dorado. And initially the whole premise around that was we were going to put a center mill that was going to be almost as a metallurgical processing facility for the region. That's what we had initially. Then we did more studies, and also I knew that area had processed arsenic before, so there was a chance to process arsenic. But then we realized that it was not the case. Yes, they did process arsenic, but apparently not having the permits at the time. And the tailings did not have the capacity, and the the land mass that we will need it to have a central mill will not work well. So, and on top of that, of course, we now know, and it's public, that Canadian Malartic will need feed for the next 10 years. So we thought, well, maybe here is a better chance. Why are we going to be paying $400,000 every year to maintain an option that we're not going to get anywhere?
Yeah.
So it was an easy decision, really, to be sincere. When we realized that that was not going to be the case and there is another option that is opening, then we just need to make a clear decision, and that's it.
It's probably not how you had wanted it in a perfect world, though.
Well, in a perfect world, that mill should have been built in the center of everything, so you can ship everything there. But when we were looking at that, we didn't have an idea that Canadian Malartic was going to run out of ore on the open pit. We didn't foresee that. We just knew that in the past, or has been at least publicly stated by the CEO of Agnico in the past year and a half or so.
Right.
And publicly stated as well that they are willing to work with the neighbors, which is very interesting for someone to say that.
It's true. These are the sort of internal politics that I don't necessarily understand, but it's interesting to observe that whole region and how everything develops as multiple players are getting bigger and bigger, and you included. So, but in that same MD&A, you mentioned that divestment from some of the physical assets will be part of your strategy going forward. Is that pertaining to the mill situation? Like, what was that going to look like specifically?
So the mill is done. The mill was only an option to buy it for $5 million.
Yeah.
We knew we were not going to buy it, so we just let it go. And then we have assets, for example, in Ontario that we'll be selling. And we're very close to do that. We have, assets that are not our main priority in Quebec as well. But if someone comes and make us a big offer, we'll sell them. We had some assets in James Bay that were never explored for lithium. And we have decided to spin them out and put into another company called Electric Elements. And we have 10% of that by putting our assets there. So, maybe we'll be very lucky and they end up having a very big discovery and we'll make money out of that.
But that's got nothing to do with the mill situation. Like, it's none of the immediate ground that's close to Marban Alliance that you'd be thinking about potentially selling for bits and pieces.
No.
Okay. Good. No. Good. Yeah. Good. That makes sense. Jose, I think I've been through most of these things that I wanted to get an update on regarding O3. What else, though? What am I missing? Anything else that I should be asking here that I'm forgetting to bring up?
Well, I mean, I think reiterate the fact that this is an asset, first of all, that has been absolutely de-risked at this point, that there is a good relationship with the communities, there is a good relationship with the First Nations, there is a good relationship with the government, things are progressing well. It is a boring part because everything will go through all the permitting process. It is what it is. We have to go through that. We're doing some exploration to have some fun and to have investors excited as well. And more importantly, we have been adding value on the fundamental basis. So this asset went from, again, 1.6 million ounces to 3 million ounces. It has gone from 10 years now. Internally, we're looking at a couple more years with Malartic Hedge, which is public, and we'll continue to that. So hopefully, the end picture will be an asset with more than 14 years mine life, $100 million per year EBITDA. For a company that is worth $100 million with, again, $1 billion in net present value at a 5% discount rate and over $200 million in assets right now.
Good. Well, Jose, thank you again for the overview. It's not easy times. These are interesting times for me to see how companies deal with it when they're in that part of the Lassonde curve. But I appreciate you being open about it and how you're going to deal with that. Hopefully get an update from you sometime soon. For now, though, I'm going to let you drop off because I've got someone else waiting here, and he's going to take me down to Chile to look at one of the largest oxide gold resources in the world. And I'm going to be hearing about it from Alex Black, who is one of the few junior mining insiders. I was going to say CEO, but he's no longer the CEO of this company, but he's one of the few junior mining insiders who have as many followers as me on Twitter, which is, I don't know if that's a good sign or not, actually, Alex. We might have to talk about this. But Alex here is the executive chairman of Rio2, company listed as Rio, that'd be RIO, on the TSX Ventures Exchange in Canada, where an average of about 200,000 shares trade each day, with a 52-week high of 64 cents and a 52-week low of 15 cents. With a market cap of about $165 million and about 340 million shares outstanding, today this is a 49-cent stock. Insiders here own about 11% of the company, 23% is owned by institutions, and 13% is estimated to be owned by high net worth individuals. I believe Eric Sprott would be one of those, leaving a little over half of the company in the hands of retail investors. Their most recent presentation tells me that after the recent capital raise, the company has about $25 million in cash, and the latest balance sheet, which is dated March 31st, shows no major debts, with about $500,000 of current liabilities, mostly in the form of account payables. That same financial statement from March this year also tells me that on average, over the last reported 3 months, Rio2 recorded about $380,000 a month in expenses, a good chunk of which actually goes into, and that's more than half of it went into employment costs. Over that same period, Rio recorded an average of about $225,000 as exploration and evaluation, consisting mostly of field support, so field work and engineering studies, with a smaller cost for drilling, and then also an even smaller cost for the community initiatives that's also included in that number. That means that administrative expenses here represented at about 60% of the overall spend, while a little over 40% went into the ground. And why that is will become here clear in a second as Alex and I go into talking. But also not before I've reminded listeners that this financial statement is nothing more than a snapshot in time, in this case specifically at the end of March this year. And the finances are likely to have changed by the time you're watching this, as this is a capital-intensive industry. So please head over to the company's website as well as setterplus.ca to look at all the numbers yourself and make sure you're getting the full picture. As I said, Rio2 holds one of the largest oxide resources in the world, and their goal right now is to basically develop this project into a producing mine as quickly as possible, targeting first production by the end of next year. The project is wholly owned by Rio, and it's called Phoenix. It's located close to the Argentina border in east-central Chile, and it's the most advanced gold deposit in that region. It's also worth noting, again, as I said, that this is a 100% oxide gold deposit, and it's about 5 million ounces big. Now, when I say it's the most advanced, I actually also mean advanced, because again, they're trying to build a mine here. It's going to be an open pit heap leach operation with a single stage crushing, and they're trying to do that within, again, 18 months from now, give or take. Not an easy feat, never really an easy feat to do anything in life, but let alone build a mine. But also, I mean, how do you eat an elephant one bite at a time? And for Rio, they've outlined 3 major bites that they want to take at this project before bringing it into production. And they're currently at bite number 3, which consists of, I suppose, smaller bites. And now my analogy is starting to break down, so just ditch it at this point. But they have to be building the site access roads, assembling the plant workshops, building the foundations for the waste dump, constructing the initial pads, building the power distribution network, and then finally commissioning the plant. That's kind of what this is going to look like, with the water infrastructure, the camp, the leach pad, the plant platform, and the plant equipment already having been delivered and or built at site. Now, why they're even going through any of this is because the 2023 feasibility study told them to do so. That was completed less than 12 months ago. And that feasibility study takes into account a $1,750 gold price, resulting in a $210 million post-tax NPV5, with a 28.5% post-tax IRR, and requiring $116 million of initial capex, which the project economics say will be paid back within about 3 years. 2.8 years to be specific. And of course, then needing sustaining and closure capex on top of that, that'd be respectively $77 and $11 million. Part of the upfront capex will apparently be financed with the help of Wheaton Precious Metals, which has a gold stream on the project for 6% of the first 90,000 ounces delivered. Then there's 4% of the next 50,000 ounces and 3.5% thereafter. All in all, that leaves Rio needing to find about $110 million, which will also be a topic of discussion later today, but they have already communicated to the market that Endeavor Financial has been engaged in potentially helping them find that money. ASIC here is estimated at $12.40 an ounce, and with a strip ratio of sub-1, 0.85 to be specific, and 75% recoverability, the project is expected to generate about 82,000 ounces annually, on average, that is, for the total of 17 years, 17 years being the LOM here. Of course, as it is with most companies, Alex here and his team don't think that that's everything that this land package has to offer. It's a big land package too, so they're, of course, hitting us with investors' favorite, open in all directions, despite the project being drilled to a depth of 600 meters, which will be interesting to watch, given that this is the only deposit of its kind for this region, specifically being that oxide gold deposit. So, but again, more about exploration in a couple of minutes here. And first things first, Alex, I think it's maybe worth taking it from the top here, because I mentioned a couple of things about what else has to happen on this project for it to become a producing mine, kind of in an effort to make me look smarter than I really am, because I'm really just reading it off the presentation. But let's maybe review that again, sort of step by step for my 5-year-old brain to better understand what exactly needs to happen here. Like, what are the next steps between now and the next 18 months for this to become a mine?
Thanks for having me on your program, Antonio. And I got to say, that's a great overview. It saves me repeating that. You're spot on. You went through the history of the project, the size of the project, etc. The next 18 months is really the execution and delivery stage of our story. And the good thing is we've done this before. I mean, we had a company called Rio Alto Mining that I founded back in 2009. We acquired the La Reina gold project from IAMGOLD back then in Peru. We took that into production. That was a run-of-mine gold oxide heap leach project as well, just very similar to this one, Phoenix Gold. We did really well in bringing that on board. Started off with an 800,000 ounce reserve at that stage back in 2009. La Reina has just been sold by Pan American Silver to Zijin, predominantly for the copper porphyry that's there, that we outlined. We did a pre-feasibility study on that a few years back. But anyway, La Reina, as it's all said and done, will have in excess of 3 million ounces put on that pad. So starting from 800,000 ounces, it was a really good performer. We also acquired Saladin back in 2014 for the Shahuindo gold project, which is about 50 kilometers away from La Reina in a straight line. And that was turned on as well as a run-of-mine gold oxide heap leach project. So 2 projects. We then sold the company to Tahoe Resources back in 2015 for $1.2 billion. So we're not only guys that know how to turn on projects, but we know how to exit as well. And so we're in this as shareholders, as you mentioned, the position that we have in this company, and it's all about creating value, adding value, and at some point somebody else will want what we've got, and we've got something pretty interesting as you've outlined. So now for the next 18 months, it's really a matter of completing the equity, not the equity financing, but the debt financing that we're going to be taking on board to cover the $100+ million of capex, as you outlined. And obviously, with any debt package, there's likely to be an equity package. And so with that equity package, it'll be a matter of determining what's the quantum of that and how much do we need to get from the equity markets. Now, we just did a successful equity raise in April. We raised 22 million Canadian with a target at the time of only 8 million Canadian. And we not by any skill, mainly by luck. We picked the right window because it was when gold was accelerating up at the time, and we jumped through that window. But what we didn't realize, and what I didn't realize, was that I had huge amount of support from existing shareholders. And as it was, out of the 22, we raised 17 million from existing shareholders, which was a pretty good validation of what we're doing with our project in Chile. So having done that successful financing, I feel quite confident that we can do an equity financing, and let's say time-wise, it's likely to be September. So getting the debt financing into place, equity financing in September. Why September? Because September is the beginning of, the financial season, I guess, after the summer holidays. No good trying to raise money in July or August. For us to recommence construction in October, and the reason I say recommence is we started construction back 2 years ago before we got stopped. We had an issue with the new government in Chile, which is now, I could talk about that, but it's now over and done with. We came out on top. We have our EIA approved. And the other thing that we have to do during the next couple of months, 2 or 3 months, as we put the debt financing into position, is we need to get our permits to enable us to build the project. And those permits can't be withheld. They're related to the EIA. All the questions have been dealt with in the EIA. So it's just a bureaucratic process in Chile. There's 4 key permits that we have to get. We're busily working through them now. There's no issues that we see. We've actually got the benefit of having our project elevated to a priority project status in the Atacama region. The Atacama region is a mining region in north central Chile, as you mentioned, and because of all the work we did in getting our EIA approved, the Ministry of Mining and the Ministry of Economy have taken our project on board and want it to be developed. One of the reasons for that is because of the high level of unemployment that the Atacama region faces. Even though it's a mining region, it carries some of the highest unemployment levels in Chile. I think it's close to 10%. So, we've been working with local businesses, with our communities, and everybody wants to see more work generated by new projects, and we're one of those new projects. We put those permits in place, we put the financing in place, we put the equity financing in place, and that means we restart in October. And as you mentioned, if you go to our presentation, you'll see that there's lots of photos there of work that we did 2 years ago in starting to prepare the pad area, in starting to prepare the plant area. And we did that under some local permits that we were able to get at that time while we were waiting for our EIA to be approved. We also went into a stage of fabrication of plant components. We're talking about an adsorption-desorption plant, an ADR plant, which is pipes, tanks, pumps, and electrical switchgear. That's basically what an ADR plant is. That's why the CapEx is relatively low, because it's all civils and a very simple plant. No crushing. We're going to do run-of-mine to start with. We've demonstrated that this project is feasible at run-of-mine. And let me tell you, if you're going to do a gold oxide heap leach project anywhere in the world, if you've got the opportunity to do run-of-mine, you'll do that over and above having to crush or agglomerate or do anything crazy like that, because of the CapEx involved and the complication involved in doing that. So we have a very simple project, and we got started 2 years ago. We got stopped, and now in October, we're planning to reinitiate. Obviously, as well, during this time, we're working on selection of personnel in Chile. We've got a very skilled team here in Lima, Peru. This is where I'm calling you from, who are overseeing the development of this project. we're all ex-Rio Alto people, so we've done this twice before. The people we're going to get in place to build the project obviously going to be Chilenos, and that's our undertaking, and predominantly from the Atacama region. And so we're building up that team. We've got 14 people here in Lima. We've got about 12 or so people now in Chile, and that's going to grow. And yeah, so people, capital, and just get going, when October comes around. And so that is why we're guiding that we think we can be producing our first bar of gold by the end of next year, by doing all these things, and because of the simplicity of the construction of the project.
Well, I'll follow up on some of these things here, Alex, that you're telling me, but why Lima? I mean, your head offices are in Lima. You're from Canada and projects in Chile. What's that connection? I suppose it's you, but talk to me about that.
Well, it's just the way the company has evolved. We're a different company. I mean, we're a junior Canadian listed company. And as you can tell by my accent, I'm not Canadian. Andrew Cox is our president CEO. He's a Kiwi, so he's not Canadian. And, when we did Rio Alto, we essentially had a couple of people in Canada, but we were all based here in Lima with our project being built in Peru. So I've been here 24 years, so I've elected to stay here. Andrew's been in Latin America and in Lima for 24 years and in Lima for 15 years. So he's elected to be here. And our team are all Peruvians, which is great. I mean, good skill base, competitive salary scenario from the point of view of G&A. So, we decided to keep that here. Now, what we have in Canada is we have a listing. We have our CFO who lives in Vancouver, Catherine Johnson. She works from her home. We're happy about that. We don't have a glitzy office in Vancouver or Toronto or anywhere like that because we don't need it. And because we've had this track record, we haven't spent a lot of money on marketing and going to conferences and all this sort of stuff. Admittedly, COVID put a damper on all that a few years ago, but it's all a matter of executing and delivering, and we've got that track record, and a lot of people are supporting us, and to the tune of $17 million just recently, our existing shareholders, because they feel comfortable that we know what we're doing, and it's all about putting our heads down and getting this project into production. And it's a starter project, as you've alluded to. It's not the be all and end all for this project.
Right. And those are also things that we're going to be talking about. Thanks for that clarification. I want to follow up on the permitting thing, though, that you told me. You said 4 permits. He basically said there's no way for them to get denied. But I think a couple of years ago, you would have thought there's no way for me to be talking about chinchillas, right? So
Okay.
how confident are you on that statement there?
Well, I'm very confident on that statement. I mean, what happened to us over the last couple of years was crazy, right? I mean, you could never have predicted it. But what we demonstrated was our resilience and our perseverance to get through that. I mean, a lot of people would have spat the dummy and gave up at the time, but we didn't, and we knew we were right. We knew that we did the right thing with our EIA, and the reason I feel very confident is we've got the Ministry of the Economy and the Ministry of Mining behind us, and as I said, we are now a priority project in the Atacama region, and they are helping us push along the bureaucracy to get the permits that we need. And the permits are and I know here am I saying this, and I would have said 3 years ago I was going to get this EIA approved, easily. But it's very much just a bureaucratic process that follows on from the EIA. All the issues, the chinchillas, the flora and fauna, whatever we had to encapsulate in that EIA being dealt with. There's no jack in the boxes out there that can pop out and scare people away now. So you just got to take my word for it. I think we know what we're doing. And once again, Ministry of Economy, Ministry of Mining, all behind us to get this thing done.
And so politically, in terms of anything has been changing tax regimes or whatever else it might be, there's nothing that you can foresee in the next 18 months.
I mean, this was an experiment that went wrong. This new Chilean government, well, when I say new, it's halfway through its period, but it was a stated communist government, and that's what's happened down here in LATAM. A big move to the left, apart from what you see in Argentina, which is a big move to the right. And you're going to see that probably happen in Chile in the next election, which is going to happen in a couple of years' time. And you're probably going to see the same in Peru. Let's hope so. Yeah, there was this communist experiment, anti-mining. It was all stated before they got into power. But what they failed, and unfortunately, the government was made up of a president that's never been in politics. He was the 35-year-old guy, came out of university, and was involved in non-profits and other things, and wasn't a business person. And so he brought along a team of people that would become his ministers that were the same. Didn't have any political experience, didn't have any business experience. And you're taking on Chile. You're going to run Chile. And as we all know, running a country is like running a business. You got to keep the wheels turning. And Chile is a mining country, and the big part of its internal revenue comes from mining. And so you can't go against mining unless you've got something alternative that will take over from mining, and they don't have that. And as you can see, Codelco is starting to find it difficult to keep up with production because it needs more investment, et cetera, for the big mines that it has, the old mines that it has, the capital expenditures that it needs to do. And it needs the government to support that so that it can pave the way for it to continue to be, the world's largest copper producer. But that was what went wrong. And then they were they tried to change the constitution. They tried to change the tax regime in Chile. Everything was voted down, and it never came to pass. And so they were dragged, probably unwillingly, to the center. And now, if you look at President Boric and anything that the Chilean government says, it's all about pro-business. We're pro-business, we're pro-business, we're pro-business. But unfortunately, there was a lot of damage done during that 2-year period, and we were one of the victims of that 2-year period. So water under the bridge, got to keep moving forward. There'll be another election in a couple of years' time. This communist experiment will be over, and we'll see a different Chile in a couple of years.
I also hope we'll talk about water and maybe bridges later on too. But to go back to some of the things that I want to follow up on. Thank you for that overview. I hope you're right there. I think everybody hopes you're right there, and it seems like this time it is going to be the case. What about financing? I wrote down to follow up on financing. Can you get more specific on where you're at, or what you're thinking internally as to debt to equity ratio for the financing specifically?
Yeah, I think what we've done is we went through a process. Endeavour Financial did a great job, great group to work with, and we've been working with them for over 12 months. We've gone through a first round of offers from banks and funds, right? Resource funds and banks. That's the group that's interested in getting involved in this project. And now we're going through a second round, which is more of a firming up of term sheets, which includes site visits and other things. So that's happening at the moment. And there's about five groups in it, right? And I anticipate that the financing that we'll get from those groups will be in the order of 100 to 120 million bucks. Now, the equity required will probably be in the order of 30 odd, US is what I'm thinking. And the reason for that is because, the banks will make you get all your contingency in place, get, cost overrun facilities, and, they'll look at a conservative funding for the project. So you're going to have to you're gonna have to fund a little bit more than what you need, right? To satisfy the banks and the risk profile. So let's say 100 to 120 and about 30 odd, 30 odd, maybe 30, 35 in US dollars in equity, and that'll be it. And then, potential cost overrun facility will be part of all that, right?
But overall, it seems like you're again you're very serious about actually building this mine yourself. That's really what I'm probing with these questions. So
yeah, no,
I mean,
that's the thing, when we got our EIA approved at the end of last year, since then we've had some inbounds from corporates. When I say corporates, other mining companies, right? Wanting to know what we're doing, how we're going, etc. And, I'm happy to talk to them. And one of the things we've had to say right from the outset is we're not for sale. I mean, we're not a typical junior company that's never done this before and goes, well, yeah, I mean, give us a good offer and we're out. No, we're going to build this project. Corporates can look at us. Corporates may want to participate in a strategic financing or something like that. Fine, no problem. We consider that. But yes, we're going to build this thing ourselves. And there's two stages to this project. There's a starter project at 20,000 tonnes a day water pad, which relies on trucked water, which I'm sure you're going to ask me lots of questions about. And then a expansion to 80 to 100,000 tonnes a day. Because of the size of deposit, we're talking about 400 odd million tonnes of mineralization here that's already been discovered. So, when you look at that, this project has the potential to grow, and we want to do that ourselves, and we can do that ourselves because of the capital intensity that's involved. We're not talking about hundreds of millions of dollars, and I can further explain that with your questions going forward.
You say you're not for sale. And I wonder if not, I mean, isn't everything for sale at the right price? And if you'd humor me, what type of premium to the current 165 market cap would it take you to consider an offer?
I don't want to talk about premiums and stuff. Look, just look at our track record. We started Rio Alto back in 2009 with a $12 million market cap. We bought La Arena into production to the tune of plus 200,000 ounces a year. We then acquired Saladin and put Shawindo into construction, and we grew the value of the company up to $1.2 billion on a takeout with Tahoe Resources. So, yeah, we know where to sell, but there's a lot of value that we think we can add that we don't need help to do, right? That's the bottom line. And because we've done it before, it's not as though we're taking a huge risk and, we're at the casino and throwing the dice on the craps table and just hoping. No, we've got a clear plan. And I think, our strategy is we've got at least 4 or 5 years in front of us to demonstrate that the second phase of this project is real and doable and is going to happen. And then who knows what's going to happen at that point. But that's 4 or 5 years away.
Why is that the decision? Like, why do you think there's more value to be had for shareholders in you building this thing instead of just, a clean out 2x sale or something like that, where it's potentially, well, I'm not going to call it risk-free because nothing really ever is, but lower risk than, I guess, building an entire mine?
I think, once again, because we've done it before, we've got the track record, we've got the energy to do it. That's one thing. Secondly, I believe we're in a positive gold environment for the next, medium to long term, I guess. So I think gold projects will become more valuable as time goes on. Obviously, right now in the market and in the gold sector, the sentiment is very, very negative, despite a $2,300 plus gold price and the majors who are producing just printing money. But that's a crazy phenomena that I believe will come back to reality at some point over the next few years. And so, as you mentioned at the beginning of this presentation, here we are sitting on 5 million ounces of simple gold oxide resources in Chile. with great infrastructure, doability, and we've got $170 million market valuation. If you look at, 250, 300,000, 250 to 400,000 ounce gold producers these days, they're carrying a plus $2 billion valuation. So, that's where we want to go. And I think there's not a lot of risk. We're not in a cyclic. I don't think gold is like other commodities like you see in lithium and uranium, and it's all very cyclic and very up and down. Even copper, copper's a very cyclic business because it's supply and demand. With gold is more or less a currency, and it's tied to the economic condition of the world, and so it's got a different feel to it and a different characteristic to it. If you look at gold back in 2014 to 2020, I think it was, or about that time, $1,200 gold price for that period of time on average. And then it bumped up, went to about 1,800, 1,850 for 2-3 years. And now it's gone up another bump up to plus 2,200, 2,300. And it could do that for another few years and have another bump up, because the dynamic around gold is completely different to commodities. And so, having said all that, I think we're in a perfect spot bringing on a new gold project and an expandable gold project to capitalize on that, not today, but in a few years' time.
I think it's clear. I think that part is very clear. You want to build this thing yourselves, and you're also good at explaining why you want to do it that way. Let's maybe talk. I kind of want to go through some of the challenges, water being one of them, and discuss them and how you've managed them, or how you're going to be managing them in the future. But it actually might be a boring, but to me at least an important place to start the conversation could be understanding what you have here as a whole, because as I mentioned at the beginning, this is somewhat of a unique deposit for this region. So yeah, Alex, how come? I mean, if this is as good as you believe, why aren't there other deposits like yours that work in this region, or why didn't anybody else think to develop Phoenix before you did?
I don't know. Need to be able to read people's minds. I think. Let me just say, catchphrase when we were building La Reina. Sorry, I'm talking about the past, but I think it's relevant.
Yep.
When we started to build La Reina with an 800,000 ounce reserve, a epithermal gold deposit in sandstones next to a porphyry, and everybody said it was, it wasn't going to work. And then as La Reina got into production, it was like, wow, this is like too good to be true, right? It's too good to be true. That was the catchphrase that everybody was, not us saying, but people telling us. Same thing here, right? This project was discovered back in 2010. It was discovered by a company called Atacama Pacific, a junior company at that time. And when they were putting out the drill results, and you can go back to their press releases back on CEDAR back in 2010 to 2014, which was their drilling period. I mean, there were holes 200 meters at, half a gram and, 0.6 of a gram. And, there were some spectacular holes that drilled today, would light the market on fire, from a junior explorer perspective. So that was happening back then. And then all of a sudden, it just sort of fell away to nothing, because it was a company run by a couple of geologists that did a fine job just finding it, discovering it, but just didn't know what to do next. And so they did a pre-feasibility study back in 2014, and typical junior company stuff, biggest project they could show, with the biggest NPV, with the biggest CapEx, with the biggest everything, and nobody wanted to buy it. Now, that was 2014. And remember, in 2014, the gold price was struggling, because I remember, because we were Rio Alto back then, and we had a dip in our share price. So, and then it just sort of lost traction and just sort of just meandered along and was put on the shelf. And then all of a sudden we come along in 2017, start talking to the Atacama Pacific people, and it took us a year to persuade them to deal it to us, but we did a deal with them in 2018. Now, that's, you know, when gold, people had a different attitude towards gold. Gold was, you know, in the 1800s, and, you know, it was a different dynamic to 2014. So, and then, you know, the majors, and like our nearest neighbor is Kinross, right? So you would have thought Kinross would be interested in this project. Why weren't they? I got no idea. They were operating the Maricunga mine to the south of Phoenix. They got into problems there with water. They had to put it on care and maintenance. They had ideas of reactivating La Coipa, which they've done over the last couple of years. La Coipa is right next to Phoenix. It's only 20 kilometers away from Phoenix. You know, why weren't they interested? I got no idea. But it's the same way that we capitalized on La Reina back in 2009. Why didn't somebody else jump in and buy La Reina back then? Because nobody really believed in it. You know, they just thought, it's just another gold project that's going to have problems with metallurgy and things like that, and it never did. So I don't have an answer to that, but that's what typically happens in this business, right?
Well, I typically make no, go ahead.
No, I was just going to say, what's the other part? I think you asked me a couple of questions, but
I was just thinking why. Well, let's leave that actually for later when we talk a little bit more about the geology, because I was going to ask why is it different geologically, but to go back to what you say, like why, or to what I asked previously, why has anybody else already picked it up? I typically kind of make a list of things like what could be wrong here, like why wouldn't someone else want it? And so one of the challenges that I came up with was the remoteness of it all, and then specifically in relation to water availability.
That's a good point. Water is a constraint.
Yeah.
I think you got to, and I know a lot of juniors talk about the fact that they've got infrastructure, they've got management, they've got everything, and they've got, you know, open-ended resource, etc. Well, we do have a very good infrastructure for our project. We're on a main road, essentially between Copiapó and Argentina. And like I said, we're right next door to La Coipa. So if anybody goes to Google Earth and has a look, they'll see the La Coipa mine. They'll see our infrastructure site. We're only a couple of kilometers away from each other. And then it's a 20-kilometer drive from the infrastructure site to the top of the hill, which is where we're going to be mining, to the south. So infrastructure is really good. So it wasn't that. You know, I think back then, you know, there was probably doubts about metallurgy. You know, would it leach properly? Yes, water. What would be the source of water there? And admittedly, you know, for example, Kinross were having problems at the Maricunga mine to the south of us with water. They had their water permit revoked by the Chilean government back then. That was a few years ago. So they probably went, oh God, you know, water, and they got other fish to fry elsewhere in the world. Big multi-asset company. So, you know, they probably didn't think much about it. You know, the other thing is the gold business in Chile is quite small in comparison to the copper industry. And there's only 4 gold players really in Chile, and that's Goldfields, who just turned on Salares Norte, which is about 150 kilometers north of us in the Atacama region. Then there's Kinross with La Coipa, and then there's Pan American Silver, and they're there because they acquired all the assets from Yamana just recently. And then there's us, Rio 2. That's the gold industry in Chile. I mean, there's some junior gold explorers around the place, but they've got nothing advanced. So it's quite interesting. It's quite interesting.
As I was talking about water availability, that's a point I want to go back to, because as I understand it, trucking water is a quick solution, it's a cheap solution as opposed to building pipelines. Well, it's cheap from an initial capital perspective, but it also kind of seems like maybe the band-aid solution of water management. I don't know if it is, but is it
We've
safe? Does it offer longevity?
we've
Talk to me
always
about it.
said that trucking water is not optimal, right? But it's the way of getting this project started. By trucking water, and I can talk a little bit more about the mechanics of that, but by trucking water, we take at least 4 or 5 years off the development timeline of this project. If we were waiting to bring water up in a pipe, or because in Chile right now, it's virtually impossible to get water rights to pull water from the ground. The reason for that is a lot of the water resources in Chile have been depleted. Underground water resources have been depleted by all the big mines that have gone on, et cetera, et cetera. All those big mines have been pushed into desal. And when I talk about Chuquicamata, Escondida, you look at the Lundin guys, which are near Copiapó, they're on desal, et cetera. So pulling water from the ground is virtually impossible. So we couldn't go there. And to develop a desal project is a big timeline, right? And a justification. So when we looked at this project, we thought to ourselves, what's the quickest way we can get this thing up and running, de-risk it, demonstrate that it works, and then worry about a longer-term water solution later. And that was by trucking the water to the project. 160 kilometers from Copiapó to the project. Now, some people it makes their eyes glaze over, right? But it works. We have to truck fuel to our project. We have to truck food to our project. We have to truck cyanide to our project. We have to truck line to our project. We have to truck everything to our project. So does Kinross to La Coipa. So does every mine in Chile. If you go and drive up and down the Panamericana Sur, which is the main thoroughfare from south of Chile through to Colombia, and you will see convoys of acid trucks. What's acid for? Copper leaching, right? There's acid trucks. They pick it up from the ports. Acid comes in on ships from the ports, but they got to get to the projects. They got to be trucked to the project. Trucking is normal. Trucking is something that happens in the mining industry. But trucking of water for the quantity we're talking about to cover a 20,000 ton a day run-of-mine heap leach project is a limit, right? In our case, it's a limit. But as you know, we can do that for 17 years if we really want to. We don't want to, but we could do it. And we're going to produce on average 85,000 ounces a year. However, we also know, and we've been watching at the development of desal projects in the general Copiapó area, and there just happens to be a project that's on the table that is near to achieving all the environmental approvals that it needs to be developed. And that's a project called ENAPAC, ENAPAC, ENAPAC. And they are going to provide water to mining companies on a third-party basis. They're not going to use the water. They're going to build a desal plant. They're going to build a solar plant to provide the energy to pump the water to wherever it's got to go. And they have got a northern line, and there's a presentation in our corporate presentation, or a page in our corporate presentation, which you can refer to. They've got a northern line and they've got an eastern line. And we're on the eastern line, the planned eastern line. Now, the gestation period of that project, once they get all the approvals in place and the financing in place, and it's owned by a Israeli/Spanish consortium. The Israelis are the water people, the Spanish are the solar people, and they're talking about getting Goldman Sachs to help fund this project. Once that starts to form itself, we're anticipating it's going to take 4 to 5 years for them to execute and to build everything and or the lines and the plants and everything else that they need to do. So we're hopeful. We don't have a guarantee yet because they're still waiting for their approvals. But we're hopeful that in year 5 of our project, we'll be turning the tap on to desal water provided by that project. Now, the good thing about that is we don't have to cover the CapEx. We already did a preliminary study on the CapEx involved, and this was back in 2019, to bring water from Copiapó to our project, the 160 kilometers, and it was about $250 million. So today it's probably a little bit more than that. But the good thing is about Enerpac is they're going to cover all the capital. They're going to say, right, there's a cubic meter of water and that's going to cost you X dollars. That's it. So it becomes an OPEX for us. Just like water is now an OPEX for us. It's the OPEX of trucking the water, the cost of fuel, cost of labor, etc., to bring that water up to the project and keep the project filled with water for 20,000 tons a day. So that's the future of this project. And that's why I said to you before, we want to be with this project, developing it to that point where we do have a definitive time frame for when that water that'll substantiate us expanding our project to 80 to 100,000 tons a day. We want to be there to do that because it's not going to consume a lot of our CapEx. That's the key.
Is it going to lower or increase your OPEX though? I mean, is it cheaper to get water from them or
we're anticipating that it will lower the OPEX because right now the cost of trucking the water to the project is about $2.40 per ton of ore on the pad, right? $2.40 per ton of ore on the pad.
Mm-hmm.
We think the desal solution will probably be around $2, but we don't know exactly. Could be $1.80, could be $2.10, but we think it's going to be less for sure. And then that becomes a relatively static number because remember, desal plant running, energy provided by solar power, specifically for that project. So we should have a static price or a relatively static price of water. In the case of what we're doing now, if the oil price was to go to $120 a barrel, then our water is going to be more expensive because we're trucking the water. If oil goes down to $60 a barrel, our water is going to be cheaper because we're going to truck in the water. So we're tied to the oil price with the cost of our water for the 20,000 ton a day case.
Is there anything else that I might be missing in my understanding of how that process is going to work in terms of you've probably done SWOT analyses and whatnot as to what are the potential challenges with trucking that water 160 kilometers? Well,
the key is, it's a truck every 20 minutes. And so we're going to have a fleet of, close to 30 odd tankers, right, going up and down that road. And that's going to be on a 24/7 basis. Managing that is going to be critical, right? We're going to have a person dedicated towards, managing that and making sure that fleet keeps running. But it's not unlike anything you would do in your mining operations. In our mining operations, we're going to have several, trucks hauling dirt from the pit to the leach pad. Similar sort of thing, obviously shorter distances, but you have to have all the controls in place and be able to mitigate any sort of issues, have trucks in reserve if there's some issues on mechanical, etc. So we've got to plan for it, but we know what we're looking for, right? And we know what to expect, and we know what we should be keeping on top of to make sure that that fleet of trucks runs relatively seamlessly.
Okay, right. That makes sense to me. So far, I guess it'd be interesting to watch it in practice and see how it happens. Another one to sort of keep it moving here of the things that I wrote down, not necessarily for you because you seem to have it figured out, but metallurgy is another one of the things that I typically check. You're at 75% recoveries right now. And I suppose two things here. How confident are you in that number? Like how preliminary is it? And how can you do something to improve it? And if you can, how?
Yeah, look, there's been a raft of metallurgical test work done. We also, during the last 12 months and with Endeavour Financial, we got SLR consultants out of Canada to do a technical review of our feasibility study, which we did with other consultants. And they went through all this. And there's a raft of metallurgical test work. And we feel confident based on our experience and plus on what we're seeing with fragmentation, etc., that we did with a trial pad, that we're going to achieve 75% recovery. Now, if anybody tells you that with a gold oxide heap leach project that they can predict what the metallurgy is actually going to be before you start stacking ore on the pad, then they're lying, right? So at the end of the day, you can only go into this with the best information you have, and just put it out there and get the material under leach and see what actually happens. Now, will it be 73? Will it be 75? Will it be 80? Will it be, I don't know. And we expect it to be in the range of 75, right? Or around 75. That's not a range. Around 75%. But we'll be pulling all the levers to make sure that happens. Fragmentation is going to rely on drill and blasting and how well we do drill and blasting and how well we can get the material down to 4-inch, etc. We think we can do that. There's going to be some testing and other things. And really, when you see a project like this come on stream, we're going to come on stream, let's say at the end of next year, there's going to be 6 to 12 months of bedding the project down, right? Because mining's not a exact science. It's a bumpy road. And so there'll be things where we will learn, okay, we should do this, we should do that, we should change this, we should change that. And when we come out of that 6 to 12 months, we'll start to see where the rhythm of the project is pointing towards. 75% recovery, is it 100,000 ounces of gold production per year for the first few years, or is it going to be a little bit more or a little bit less, et cetera, et cetera. So, mining is not an exact science. Heap leach, particularly gold oxide heap leach, is not exact. But I think there's been a lot of work done, and we feel quite confident of our experience to manage whatever bumps come up along the way.
But you don't think that there's a possibility or probability for you to move this sort of in the next stage of recoverabilities, which would be in a 90% range?
No, I think when you see the tails of the leach curve, sort of tails out at somewhere, close, it goes 75, could go to 80. And I think, when you have a leach pad and you start leaching, materials under leach virtually all the time, right? So there's a residual leach curve. And so 75 is what we're expecting, but it will probably be closer to 80 over the life of the project. I don't know. Time will tell that.
Right. Okay. There's another one of my mining catchphrases that I've written down, and that's strip ratio. You're sitting at 0.85, so that's sub 1, which is of course great. Makes sense for this type of project as well. Same thing. How confident are you in actually achieving this over the LOM? Anything else you can do to improve it? Do you even want to improve it given where it's at? Talk to me about that.
But any mining company, when it's in the mining phase, will look to do whatever it can to improve on all facets of the project: metallurgy, fragmentation, and every facet of it.
Mm.
So, your question, sorry, I've just lost the thread. Your question was about what? A senior moment. I'm having a senior moment. What was your question again?
Whether you can improve on the strip ratio being sub 1, and
Oh,
whether you
okay,
even
strip
have to
ratio.
or want to.
Yeah, okay. Let me just say one thing. Remembering the reserve estimate was done at 1750. Actually, 1650 was the pit optimizations, but 1750 was the financial model. With the gold price at 2300, a lot of our waste material becomes mineralized.
Yeah.
So what you're going to see is if the gold price stays around $2,300, we're going to see our cutoff come down a little bit, and we're going to see more ounces put on the pad. It's just, and so therefore less waste. And so that strip ratio might come down to 0.8, 0.75. I don't know, it'll vary, but it's very gold price dependent. Once again, I'm going to go back in nostalgia, back to La Reina. La Reina, the head grade at La Reina right now is 0.32, right? 0.32, which is less than our average reserve grade at Phoenix Gold. And the cutoff grade at La Reina is below 0.1. If you can imagine that, it's below 0.1, and it was below 0.1 when we were there. So, that's the beautiful thing about these bulk tonnage gold oxide heap leach projects. They can be pretty powerful beasts once they get going and you have a favorable gold environment.
I think you want to have a check though, Alex, because you're not supposed to have senior moments at 45. I'm just saying. One of the other
I wish I was 45.
one of the other catchphrases that I have on here is, and you're mentioning the grade, so it's kind of fitting, continuity. And so this goes into the geology weeds a little bit, but given that there's the brecciated volcanic host rock that you're dealing with here, do you have to take any extra precautions or do anything special to ensure grade continuity, or at least lower the risk of major grade variability over the life of mine?
No, I mean, as a miner, we'll be doing grade control drilling in front of our mining. We'll be defining where the edges are, cutoffs, etc. The edges between ore and waste. No, this is a big chunky deposit, from the point of view of the brecciated volcanics. So it should be pretty straightforward. And just to go back to that, I know you alluded to this earlier. This is the only deposit of its type in the Maricunga region, right? This is a low sulfidation deposit, as opposed to all the other deposits in the Maricunga region being high sulfidation. And what that means is that we're not associated with a porphyry, right? Most of the other deposits are associated with porphyries, and they have copper concerns, etc. they've got to deal with. And typically they have a leach cap, a transition zone, and then a sulfide zone. In our deposit, we're 100% oxides to the deepest hole, which is 600 meters below the surface. And so one of the curious questions is, what's happening below there? What's underneath this thing, and how deep can it possibly go? So it's a different animal to even La Coipa, Lobo Marte, Volcan, La Pepa, Serracasali, Caspice, all those other deposits in that gold deposits in that Maricunga belt. They're all very complex, and the complexity means big capex, big throughputs to justify, the complex metallurgy and other things. So we don't have that. We're lucky.
I like how you're not rolling your R's after 2 decades in Latin America, when you're speaking these names out. You mentioned complexity, and that's actually fitting as well, because I wrote down black banded quartz veins equals complexity question mark. That's in my notes, and what I mean by that is that doesn't that necessarily make it harder for you to model the ore body or come up with exploration targets?
No, because No, because we're not modeling the black band. We're not modeling the veinlets discretely, right?
Yeah.
I mean, they are within a mineralized unit, right? And they're pervasive. They go all over the place, right? They crisscross all over the place. So, and that's where the higher gold values are, but the lower grade volumes are in the material around them too. So it's not as though that's the only place where the gold is, and you got to go in with a spoon and start digging those quartz veins out. No, that's not the case. So no, they're not the complexity. They're the juice. They're the juice to the mineralization, really.
Probably means you have beautiful rocks too when you look
The
at them.
rocks are nice and simple, and there's no fines. You know, one of the things is when we break this material up, there's no clays, there's no fine material, there's nothing that's going to clog up the leach pad, which is very important. You got to look at, you know, percolation, and you got to make sure you don't have, you know, like sand or gluggy material in the pad that will deviate the leach, you know, the solution to different places in the pad and not just straight down, because you want to try and go straight down as much as possible. So we're lucky we don't have that. Even if we have to crush, and that may be something we do in the future, and that will be looked at as we continue to mine this deposit to see how fragmentation behaves. But even if we have to crush, good thing is we don't have to agglomerate here because there's this lack of fine material and clays.
Yeah, that makes sense too. What do you, in terms of exploration, knowing all of this that you're telling me here, I mean, what do you know about exploration? Where do you go from here? What do you target?
Well, let's just look at it simplistically. I'm not a geologist. Let's look at it simplistically. We've got 5 million ounces virtually in M&I. And we've got about 1 million ounces in inferred. We think it's open in various directions. In fact, we've done a couple of years back, we did some geophysics and everything, because we were getting ourselves set up, because our plan is to actually start exploration geology or exploration drilling once we start producing. And we've always had that objective. So we did a bunch of geophysics back a couple of years ago, which has outlined some really nice targets around the ore body, right? Not distant, but around the ore body, at depth and extents, etc., that we want to test once we get started here. So our intention will be to pull up a couple of rigs once we start production and be doing depletion drilling, you know, so as we deplete the ore body by, you know, 100,000 ounces a year or whatever the number is, that we try and replace that 100,000 ounces with new material. So yeah, no, there's lots of interesting things, but what do I think this project will become? Starting with 5 million ounces, I think at the end of the day, it's going to be somewhere between 5 and 8, probably maybe 10 million ounce deposit based on what I'm seeing. Once again, I'm not a geologist. I don't have a crystal ball, but I think that's potentially where it's going to go. Could be 6, it could be 7, it could be 8, it could be, but it could end up being quite an interesting deposit over time.
Where is all that extra material going to come from, though? I mean, is it so that Phoenix Central and Phoenix South are going to connect? Is it going to come from depth?
Potentially at depth and laterally, because there are zones laterally that we want to test. There are some areas that just weren't drilled enough and didn't make it. So we really want to cover those areas off. And once again, we'll do that in the first couple of years of production.
Well, you mentioned that we touched upon it multiple times here, but do you have a reason to believe that the deposit will eventually switch over to sulfide mineralization the deeper you go?
Oh, that could happen. I mean, we don't know. We haven't encountered sulfides. So one of the things I'll be talking to the geos about is, you know, when are we going to spear some holes, you know, at depth to see what's under, because as I said, 600 meters, we're still in oxides. So when are we going to spear a hole at 800 at a kilometer to see what's there, right? And you know, we'll definitely do that from a curiosity perspective. But as I said, we don't have there could be we don't know. There could be a porphyry. Once again, I'm not a geologist, so geologists don't kill me here. But there could be a porphyry nearby, could be something down at depth. I just don't know.
You sure you're not a geologist? I mean, drilling 1 kilometer holes for the sake of curiosity sounds like a thing a geologist would say.
Well, when you got cash flow, you can do that, right? I mean, we wouldn't do that today, but if you got cash flow, why not? I mean, you should be doing it, because if you've got a deposit that plunges, vertically, you should be looking at, well, where does that stop?
What are you going to do with that cash flow? What else are you going to do besides drilling 1 kilometer? So, I mean, you have to replace
pay back debt. So
sure.
pay back. Oh, there's my thumb. Pay back debt, and get ready for phase 2. Phase 2 is going to cost some capex at the project level. When I say that, plant expansion, pad expansion, etc. So we're going to have to start building up a balance sheet and a bank balance to cater for that. Depends on how much money we make. We might return some money to shareholders. Who the hell knows? I mean, bit unrealistic for a new miner, but at some point it might justify doing that. Who knows?
That's kind of like when I require certain things from my wife, she always says one day, but not today.
Exactly.
But you have to replace ounces, I mean, sooner or later. So that's too early maybe to speak about these things.
Well, the good thing is, Antonio, that we're starting with 5 million ounces. I mean, that's a good place to start, right?
Yeah.
And so, there's not a hell of a lot of pressure on us to go from 5 to 10, right? But we will methodically start to build on this, we feel, given success, once we get to production.
And you're only mining 1.5 million ounces over that 17 years.
1.7, I think, is what we predict we're going to mine. Yeah, something like that. And it's only a small subset of that whole thing. That's why, the starter project is not optimal. It's just a start. And the real project is the 80 to 100,000 tonne a day case. And that's when you start to get to 250, 300,000 ounces a year. And that's that's when you start eating into this 5 million ounces.
Yeah. Yeah, it is. And that's probably an even bigger challenge, and potentially a podcast in and of itself, to talk about how to get there and what the right way really is to get there. How do you, for yourself, when you look at the share price, it's recovering very nicely. As I said, the 52-week range is nice. You're closer to the 52-week high than you are to the low. Kind of a difference here with a lot of the junior minings there. But you're in the middle of this, of what's called the boring engineering phase, or the where the Lassonde curve is basically punishing your share price. It hasn't happened yet. The gold price is supporting you. You're coming back from being undervalued on the back of that permit and so on and so forth, all the things that we talked about so far. But how do you keep the market engaged in this phase if you're not doing too much exploration, or you're not buying new projects? You're doing nothing crazy, and this market likes crazy. So how do you keep it happy?
We just look, a lot of people don't think we're going to, this project's going to work. There's going to be problems. So we just got to execute and deliver on the project. Having said that, I mean, I've always been an exponent of M&A. So I've said we're not for sale, but could we be a piece of something bigger with somebody else, like another junior with another interesting asset? Sure, and that could be some other thing that we do along the path is M&A. And we've been looking at lots and lots of opportunities. Good thing is we've got an internal team that can look at these things. But most projects out there belonging to other juniors have got hair of some sort belonging to them, whether it's technical, whether it's social, whether it's political, whether it's, whatever it is. So, there's got to be a right time for us right now. Our head's down to get this project financed and into construction. After that, we could do some M&A. I don't know. I don't like being a one asset company. And I think we demonstrated what happens when you are a one asset company and something goes wrong, like what happened to us 2 years ago. So, it's tough. It's a tough road for one asset companies if things go wrong. And so you've got to try and mitigate that by looking at other opportunities.
Are those other opportunities in the same jurisdiction? Do you want to stay a one jurisdiction company?
No, not necessarily. I mean, part of the diversification is geopolitical risk diversification.
Yep.
So if you can pick something up in some other part of the world, it makes sense. Obviously, with who we are, our team, the Americas makes sense. But would we pick something up somewhere else? Maybe. It just has to be a standout to take us to some other place that may not appear, obvious. But yeah, we're not. Yeah, I mean, we're keeping our mind open. The junior sector is big, as you know. There's probably too many companies in the junior sector right now. So yeah, we're looking all around the place.
Right. Okay. I want to, Alex, you really only promised me an hour, and I've already taken more than what you gave me. So I want to work towards closing it up. What's the next news release going to be about?
Oof. Next news release hopefully will be permitting in place, and then the release after that will be the financing. And I guess what we hope to do is we want to be able to announce the debt financing and also an equity financing at the same time, right? So and that's likely, the timing of all that's likely to be probably in around September, and that's driven by the fact that everything's dead over the summer holidays until September comes around again, and that's when the market's open again and people are back at their desks, and that's fine because it suits our stated objective of having the money in place and commencing construction in October.
I can confirm that my response rates over the summer dropped from about 1% to probably 0.5% of the companies that respond to my emails. So I'm happy you did actually, and quickly. So I appreciate that.
Well, I'm in winter down here.
Oh, that's right. That's why you're answering so quickly. You've got nothing else to do. Well, that makes sense.
That's it. Yeah, that's it.
There is something you could do, and this actually relates to the last question that I wanted to ask you, is that you are, or you have been at least, it's toned down a little bit over the last couple of months, but you have been critical of many mining CEOs or many junior mining CEOs sort of on Twitter. So I guess you could be on Twitter and kind of talking a little bit of smack here and there about some of the mining CEOs. Well, you stopped doing that, and I don't want to. I thought I'm gonna ask him, who do you hate the most? But let's end it on a positive note. Who do you not hate? Like who do you like out there? If I had some money to deploy, who would you trust that money with?
What I do on Twitter is not a matter of hate. It's a matter of help. What I'm trying to do is help people to understand, some of the statements being made and some of the things that are happening in this business. Like, for example, I mean, the thing that's really made me furious was that big accident that happened in Turkey with Silver Standard, or SSRM, or what they're called, and the leach pad failure. 9 people got killed, and nothing. Not one of the C-suite, not one of the board, not one of anybody got terminated or took the fall for it or anything. I mean, it just goes on. It's like, okay, well, we're fine. And, those things need to be called out. Some of the junior codes need to be called out because, there's some blatant rubbish that's being said. Unfortunately, I'm a CEO of a public company, and some people get pretty antsy about me saying things about other CEOs. but one day I won't be a CEO, or I'm not a CEO today, but I won't be an executive of a company, and then I can let loose. But no, it's just trying. I'm just trying to help people, and it's not about hate. And from a positive perspective, yeah. Look, unfortunately, there's only a handful of positive junior stories out there. I mean, today Snowline puts out their inaugural resource. They're in the Yukon. What size was it? 7 million ounces or something like that in all categories. So great news, and great story, great discovery. It's Yukon, so it's got some, challenges from that perspective. Yukon's a mining district, but, there's a lot of things that go with it. So that's great. And I hope they, get the project advanced, or they're being talked about as being a takeover candidate, etc. They've got a good valuation. I think it's, 800 million or something like that, maybe more. That's a great story. But, there's some smaller guys doing some interesting stuff. But the guys that are generally executing and delivering on what they're saying are the ones that people should follow. They should forget about the early stage exploration stories, because that's just draining the market of some of the positive sentiment, because it's difficult from a discovery perspective. But once something's discovered, it's great to see things being advanced and value added.
Let's go back to the question, though. You didn't give me any names. Who do you like?
Who do I like? Well, I just said Snowline. I like Snowline.
Sure. I meant more like people. I know you like Doug. I like Doug too. I talk to Doug a lot. But sort of from that perspective. Yeah.
Dougie Ramshaw. Yeah, well, he's a gentleman of the business, so I treat him like that. No, look, people-wise, I mean, I don't know. Well, who do you like?
I'm not I shouldn't be asked that. I haven't been a good judgment of people, actually. At the beginning when I started, lost me money too, and I'm kind of I've built it back on
Yeah, but
one
you know
look,
what,
but
yeah, what I'd like to say though, just in wrapping up on that, I mean, it's hard to say that guy, obviously Robert Friedland, what an ambassador for the industry and for copper, etc. He's a great guy, but he's in a different stratosphere to us junior people. I think, the junior end, it's all about teams, right? You got to have a team. And yeah, sure, I'm a mouthpiece for Rio too, but let me tell you, the guys that are in my team are first class. And I would say I've got the best Latino management team in this part of the world. So, but if I didn't have that, I wouldn't, we wouldn't be achieving what we're achieving. So it's all about teams. And so, yeah, Doug's got a good team, Doug Ramshaw. I think I've got a good team. There's a few out there, not many, but there's a few out there with good teams, and I just can't. You put me on the spot. No, I need to do some research, but I just can't give it.
We'll talk about it next time. It's a good point. Good, Alex. Again, I've not been too respectful of your time, so I'll just stop it here. But I really do appreciate you taking your time to speak to me. So thank you so much for doing this.
No, I really appreciate you reaching out to me. And this was interesting because I didn't reach out to you. You reached out to me because you've got some subscribers that wanted some questions answered, etc. And I'm glad you did. I'm a subscriber to your YouTube channel, so I watch the interviews that you do there. You do a great job, and we just need more of it. And when I retire, I'll be doing my grumpy old mining guy podcast sometime in the future, and then I'll be able to say exactly what I feel about certain things.
Well, you're always welcome to come and do it here. You don't have to build your own platform. I'll happily steal your views there and and maybe make some people angry. But thanks so much for doing this.
Okay, thanks, Antonio.